Good evening, everyone. It's already 5:32. Our scheduled time is 5:30, so uh, we should proceed now. We should begin now. Till now, almost 90 participants have already joined. Let's start. Good evening, everybody. Welcome to this 4 days mega conclave on valuation and ICI Valuation Standard 2018. The program is conducted by Valuation Standard Board of ICI upon the request from ICAN so as to benefit the members of ICAN in the valuation domain, which is the demand of valuation expertise is increasing in Nepal's economy due to ongoing merger, acquisition, and other corporate restructuring activities. Today is the third day of the program, and in the first session will be taken by CA Drushti Desai. I would like to welcome her as well, and I would like to uh, present her brief professional profile. CA Drushti Desai is a renowned registered valuer and a well-known chartered accountant from India. She has more than 20 years of experience in valuation of shares, businesses, and tangible assets. She also provides advisory services on schemes relating to mergers, acquisitions, spin-offs, etc. She is presently working as a partner at Bansi Mehta and Company and has worked for a broad range of top-tier Indian and overseas clients and has extensive experience in the supervision of large valuation and merger and acquisition assignments across industry segments. She has written various technical content on valuation, and she has addressed many seminars for ICI. With this brief profile of our resource person today, I would like to inform that she will be taking class on ICI Valuation Standard 301, which covers business valuation. Now, without delay, I would like to hand over this session to our resource person, CA Dushti Sesai. Madam, please, you may proceed. Thank you.
So first of all, thank you, Sumanji, for this wonderful opportunity that is given to us to talk about the way we carry out valuations and the standards which were codified. And it's really a pleasure to connect with all of you in Nepal. It's really a pleasure. And this virtual world has opened up a lot to us, including these kind of sessions. And in fact, just because we are on this topic of valuation, I can say that cross-border valuations and valuations from across the globe is that it's without any boundaries. Anybody can do work for any part of the world in a remote way, and I think this is a great opportunity for all of us from developing economies where we have certain cost advantages, and definitely we can leverage that against the services requirement in the other parts of the world. So with this, I would like to first of all say that this is Valuation Standard 301, which is on business valuation. And I would say that I'm very privileged that I could be a part of drafting of this standard also. Now, valuation standards, I would say, is not really anything new. It is just something which is a codification of the contemporary practices in the field. So when we say business valuation standard, it is just a codification of the practice which is followed for the purpose of valuing business. Okay. The reason why this kind of a standard is very helpful is because when you have, supposing there's any litigation, I would say that if you're following the valuation standard, then there is definitely a fallback for you to say you have gone with whatever is provided in the standard, which is very comprehensive. So if you've gone with the standard, then the chance of somebody saying you've not exercised diligence will be less. You will have a stronger case. So valuation standard helps the valuer in various ways. So even in litigation, valuation standards really go a long way if the valuer has followed the standards. Okay, this valuation standard is a very comprehensive standard which covers every aspect. When you look at every line means something. So what I'm going to do is today I'm going to decipher this standard, and I'm also going to talk about the practical aspect so that the standard carries a meaning. Otherwise it is theory. So we don't want to just look at theory, we want to give meaning and practical angle to the standard which is there. In case if anybody has any questions, we can take it up and at the end. Okay. So as I'll do one thing. I'll share my screen. I have a presentation to make. I'll just yes. Okay. Can you see my screen? I guess yes. My screen is
Yes,
visible
ma'am.
now. Right. Okay. Okay. Perfect. Yeah. Perfect. Perfect. Okay, so as we can see, the valuation standards actually provide a guidance for valuers to do valuation for different types of engagement. So there is a list of various types of engagements which we normally see are which we come across, and the various occasions which lead to valuation requirement for valuation are financial transactions like acquisition, merger, demerger, buyback, ESOPs, redemptions, conversion of various financial instruments into another financial instruments. All these things really require one to carry out a valuation. Then you have dispute resolution, litigations. So all these matters also require valuation to be carried out. Then we also have the financial reporting. Now we have Ind-AS, and then under Ind-AS, there are certain assets which have to be recorded at fair value. You have to test for impairment. So all these things also will require one to do a valuation, fair valuation, and for that, this standard can be of great help. uh, there can be also family settlements. There would be families. You have to find out the fair value of the various family interests. So there, that is also where valuation comes very handy, and you can use this standard. And of course, we have IBC in case of insolvency and bankruptcy code, which is a very robust field of practice. There also valuation is absolutely, I would say it is very critical, because if you don't get the value right and the assets are sold at a value which is unjustified, then I think it's a national loss, because ultimately the lenders really lose out on a lot of money. So these are some of the instances that that are there, that would require valuation to be carried out for business, business interest, shares. So there are different types of valuations which will be required. You may, supposing there's a transfer of undertaking or acquisition of an undertaking, then you are just going to do a valuation of the business. But if you are going to, if you have an acquisition of say shares, or if you are doing a merger or a demerger, in that case you would have a you would have to go with the valuation of shares. And that is where you will have to follow certain other norms also, which will come to later. So there are different types of valuations which are required, and we will talk about that. There are three types of values which are found. It's ultimately just it all stems from the same thing, like enterprise value. What is the enterprise value? Enterprise value is of a business is value of every rupee invested in the business. In short, that is, you have the equity value plus the value of all the other instruments which are issued by the company, and you also have the value of the debt sitting in it. So basically, all the resources of funds are valued, and that gives you the enterprise value of business. It's a very important concept, because enterprise value plays a big role when you are looking at acquisitions. I'm not saying for merger, demerger, enterprise value plays a very big role. Ultimately, everything stems from that, no doubt. But the reported number would not be the enterprise value. But when you have an acquisition, enterprise value plays a very big role. Also, in case of benchmarking of the values, enterprise value is a EV to the benchmark is a very important multiple. So EV is a very important, I would say, factor. The good part about enterprise value is that it takes all the funds together. So even if there's a company which is not levered, or there's a business which has not borrowed, you get a particular value. There's a company which has heavily borrowed, So even in you can compare, if it is EV, then you can compare the two companies, one with borrowing, the other without the borrowing. But you can compare the two because you are at the level of enterprise value, which is inclusive of the value of the borrowing sitting in the company. So that is EV. Next, we have the business value. So that is the value of business for all the shareholders, which means that even value attributed to the preferred stock is included in this. That is business value. And third, we have the equity value. Everybody knows about the equity value. You find out the equity value, you compare with the traded price. You can find out the ratio based on the equity value. So equity value is also a very important concept for the purpose of all the uh, restructuring restructurings which are done for ESOPs. Also, when you have to find out for an unlisted company what is the value, then you'll have to find out the equity value for the purpose of ESOPs, where the employees are getting shares of the company. And you have to find out, at least in India we have this perquisite valuation. So there again you have to find out what is the value of the equity. So that is the equity value after reducing from the enterprise value the value of all the other instruments like preferred stock and debt and all debt instruments, and the residual value that you get is the equity value. So we will start with the method of valuation. I would say it's very important to understand this. What happens is, initially when one starts doing valuation, one would simply start with the valuation working, without analyzing adequately beforehand about the business and the comparable. So first one must do enough brainstorming when a valuation exercise comes up. So first you find the premise of valuation. So premise of valuation, there are 5 premises. I will come to that more in detail a little later in the next slide or something. And if you see what are the premises of valuation, then just a minute. Okay, so there are several premises of value. It's a very interesting concept that there is highest and best use, going concern value. Then you have the as is, where is value, orderly liquidation, for and forced transaction. These are some of the 5 premises of valuation, which are I would say which are codified in our standard. And these are, I think these would cover most of the situations which would come up. There could be various combinations of various premises of valuation with different valuation bases. I'm sure you would have discussed in the previous sessions valuation premises and bases, but I will discuss it a little bit here also, so that we can link it with what we have to discuss going forward. So first one has to define what is the premise of valuation. Next, you have to analyze the asset which is to be valued. So asset is, business or the stock which is to be valued. You have to analyze the asset. So what do you analyze in that? You will see the growth pattern. You will see the capex pattern. You will see, if there is any management change. So there are several things, and they are very practical, but it's very important to analyze in depth the asset which is being valued. If you don't analyze well, your comparability with the other assets will not be proper, and because of that you might go wrong. In fact, not might, but you will go wrong if you don't analyze the asset adequately when you get the valuation assignment. So first one has to sit with the financials, look at the financials from the first page to the last page. You will even read the director's report. You will see the economic outlook, impact, everything one has to understand, because all of this has an impact on the growth and the future of the company or the asset that you are valuing. So you have to analyze the asset. You'll see the debt, the leverage of the business, all those things you'll see here. Then it is also possible that you would have got some projections. You would have discussed yesterday that one of the approaches of valuation is the discounted cash flow approach of valuation, right? So in this discounted cash flow approach, they would have, the management would have provided to the valuer the projections. Now, do you take the projections as it is? No. one should actually analyze the projection. So we have certain standards, certain guidance in India, where there are certain parameters laid down even for validating the projections. One should follow certain, those kinds of validation measures. Like, I'll just give you some examples. Say for example, if your client shows that he is manufacturing, say, 100 tons of something. He has the capacity to, say, manufacture 110 tons, and then you find that maybe in the projections he has suddenly jumped to 300 tons. Okay, so now the capacity is 110 tons. He's manufacturing 100 tons. So you will have to then go into the reason why he has increased his capacity, which would mean that he must have incurred some capex. He has to have shown the capex in the projection. Now, if he has not shown the capex in the projection, then his projections are far from realize means the realistic projections, because you cannot increase production without increasing the capacity. You don't have the capacity to manufacture something, how will you do it? So these types of things that you have to see. Another very important thing that you must observe very clearly is that there is always this assumption given for working capital. So when you analyze the projections for working capital, you know that, as a normative, yardstick, there is certain number of days for working capital. Supposing in that particular industry, the number of days of debtors is, say, 46 days or 50 days, whatever. Okay. And in the projections, if your client has said that, okay, this number of days comes down to 15, you should ask a question, why does it come down to 15? So you have to do that kind of in-depth analysis of the projections. One cannot take projections at face value. Although we say that the projections is, the responsibility of the management, but we need to apply our mind, analyze the projections for every aspect of the projection. So an analysis is very important. Next, you have to identify the comparables. So identify the adjustments. So there are identification of certain adjustments which have to be done. Like, for example, if your client has certain assets which are, say, non-operating assets. Okay, so then those assets, like, I'll tell you what is the meaning of non-operating assets. Say, supposing he's got certain premises, and those premises are not put to use, and because of that he's let it out. He's let out, and you can see in the financials there is rental income. Okay, so it's not put to use for the purpose of business. Rental income is not the normal business of your client. The business of your client is really, manufacturing. So you will then have to do this adjustment from the earnings, and you will have to identify this kind of, like these items like interest, dividend, rental income, expenses which are non-recurring. You identify those, make adjustment, and also you will have to identify comparable companies and do similar adjustments for them from their published results. Next, you have to now come to the application of the right valuation approach. So here in the valuation standard, we have listed down all the different valuation approaches which are relevant for the purpose of business valuation. If you see the approaches to valuation, they cover all types of valuations, including valuation of intangibles. What we are looking at is business valuation. Therefore, many approaches which are there in intangibles asset valuation will not be applicable to valuation of business. So you will have to see what is the correct way to go about valuing this particular business, and for that you will have to understand what is the right framework to be adopted for that particular business. I am going to deal with this more in depth in the later slides, but I just thought it is important first to decide on what is the approach that is to be adopted. And for the purpose of documentation, I'm going one step forward, and I'm just also telling you that when you do documentation, ensure that all that you have done, all the work that you have done, like the analysis, the identification of financial, non-financial data, identification of comparables, and also the reason why a particular approach is used and something is not used. It must be documented so that nobody can allege that there is lack of diligence. And next you come to a range of values, and then you have to see as to, we'll come to that, as to how do you deal with the range of values that you arrive at under different approaches. Okay, so this is the entire exercise of valuation, and ideally one must follow this in this exercise in this form only. Next, now, as I told you, I said that there are various premises of valuation, and okay, so this is a very interesting concept. You will wonder as to, like, for example, I'll give you an example, because otherwise it becomes too theoretical. When you say highest and best use, so I'll give you an example, that when you are looking at various premises of valuation. Now, supposing there is a plot of land on which there is a hotel. This area is supposing an upscale residential area, and the hotel is almost shut down, not really functioning well, right? Now, when you are doing the valuation, there are various concepts which are available to you, whether you'll use the highest and best use, you'll use the going concern value, you'll use the as is where is value, orderly liquidation, forced transaction. So in this case, I gave you this example I've given you because you will be able to analyze this type of an example under all the premises of valuation. Okay, and depending on, and I would say that since you have to give the best value, I would say that in a case like this, you can very clearly see that maybe the highest and the best use can give you the best value. But for the purpose of highest and best use, in this case, the example that I gave you, you'll have to see the alternate use of the asset, which is a development of an upscale residential complex. And when you have a development of upscale residential complex, it takes time to get the approvals. There is cost involved. There are very high cost of construction, cost of approvals, cost of borrowing, what will be the debt equity. So all these things one has to really capture and build a value based on this highest and best use. Now, in this case that I talked about, the going concern value, which will be just the hotel which is partially functioning, will hardly give you a value. So you will still do you may do a going concern value, or you will just shove it aside saying that this is not relevant because it's not really giving any profit also. So there is no value under the going concern. Going concern, because you will change the user and you will give the highest and best use. Going concern as a hotel is not what you are going to give in this case. As is where is again is a fair valuation. So in as is where is valuation also, you will, in this case, you will probably look at just the hotel, which is not what may give you the best value, and so you may not take that value. Now you can even look at the orderly liquidation. So unless there is, okay, so I am sure you must have discussed about what is the meaning of orderly liquidation. That is a liquidation which is not done under any pressure. It is done in a very orderly manner with the best value received for the asset which are liquidated. So in case of orderly liquidation for an asset of this type, you can actually even receive from, say, a real estate developer a good value, and he probably will have his own margin. But anyway, for a person who's a hotelier, to move to a real estate means a residential complex development, will have to anyway engage a developer. Now when he engages a developer, he will anyway have to pay to the developer some development charges. So maybe even in this case, your liquidation value also can give you the same or better value. So it all depends, if the developer is willing to buy, and he has got greater expertise and efficiency in development, then he will obviously be able to give you a better value. So one has to see, then orderly liquidation could give you a good value even here. Forced transaction, now that is also possible, supposing the hotel is highly indebted. and the lenders have taken over, there can be a situation of forced transaction, and then the lenders may look at a sellout of the property to a developer at a discount, because they want to get out and get some return on the money which has been blocked, because bird in hand is worth two in the bush. It's better to get the money out rather than wait for the things to develop and then the hotelier to pay. So these are some of the means. I just thought I'll just build in along with this, some practical aspects, and then we can discuss this. So then another thing is that you can also okay. So in highest and best use, the other thing that one can build in is also the synergies. I'll give you an example. So what is the meaning of synergies? Like, say for example, if there is a um, uh, in a high means distressed kind of plant which is highly levered, and because of the financial distress the cost of funds is very high for that uh, the plant operator. And so say he is say borrowing at say 14%. Okay, his cost of funds is say 14%. I'm just giving you a very hypothetical example. It may not be, it would not be correct, but I'm just saying, supposing his cost of borrowing is 14%. Now, otherwise the plant is good, EBITDA positive, everything is fine, quality is good. Working capital, he doesn't have the working capital, and so he's not even able to manufacture adequate quantity to turn around in a better way. So there's a acquirer who is flush with funds. He's got he's AAA rated borrower, and he will get say funds at a much lower cost. Say he gets at say 9%. Okay, so if he's getting at 9%, this guy is at 14%. And when this person who is acquiring has to put his value, then he may even go up to 9% for the purpose of discounting, because you may look at a discounted cash flow approach for this kind of a plant, because if this plant was to function at normal capacity with normal working capital which the purchaser would bring in, then there would be then he would be able to service his debt, and he will be able to just like pay only 8% cost on his borrowing. So highest and best use can also be a case where you are building synergies which are available for that transaction. I've come across cases, I've done valuation, and this is really important to take this into account, because the acquirer's benefits must be taken in, I feel, because acquirer definitely has, because when there's a distressed seller, the acquirer can bring in a lot of, not a lot of value on the table. At least some part of that value has to be given to the seller, which can help the shareholders and also the lenders to get a decent value for the asset. Otherwise, the asset will carry no value. If you're just going to value this particular asset as in an as is where is valuation approach, then there's no value. You will just have to look at the value of land in liquidation, and probably the scrap value of plant, which is absolutely not right, because it is going to be sold as a going concern. So these kinds of aspects are very important. It can give very different value if you are not to consider these types of synergies and the aspects which come along with the acquirer. And we know that in the framework of valuation, that is the valuation standards, there are certain tenets which have been laid down, and one is that valuer has to use his judgment. So here also I very clearly brought out there in the standard that the valuer has to see the situation, and he has to decide on what is the best way and what will happen to this asset, and accordingly do the valuation, so that you are not shortchanging anybody. We are looking at public interest, we are looking at lenders interest. We cannot do a valuation which is not in the interest of lenders, not in the interest of public. So very important. Okay, so these are some of the premises which I discussed along with my practical angle. Next, we come to the valuation basis. Okay, Now, valuation basis, as you would have discussed earlier also, but I'm just again highlighting them. So there are three bases of valuation: fair valuation, participant specific, and liquidation value. So fair valuation is the, like normally when there is nothing wrong with the businesses, everything is going smooth. The best thing is just to, do a fair valuation on an as is where is basis, and that would be good enough, right? So what is fair value? Fair value is a price in an orderly transaction in the principal market at the valuation date under current market conditions, regardless of whether that price is directly observable or estimated using another valuation technique. Okay, so whether it is directly observable or used. So this is a typical thing which you have to keep in mind, that we have a lot of stocks which are listed on market. These stocks have, there's a lot of price movement. There's fluctuation in the market price of these shares, but does it mean that the value of the company has really undergone so much change? May not be. In fact, when you do a valuation, fair value of a business based on, your DCF, or you use certain benchmark multiples, you use the capacity multiple, various things, and you come to a fair value of the asset, you will find that probably the market price would be very different. In many situations, I have personally observed that the market price is far higher than the value that you arrive at under the DCF approach, the cash flow approach, which is a very realistic, value for the business, because that is what you're going to earn. But the market doesn't have that all the information which is available to the management, and because of that, you can say that sometimes, most of the times, in fact, I would say of late, market is, market values the asset much more than what you would find the fair value of the asset. And that is where this sentence comes, whether that is observable or it is estimated using other valuation techniques. Next, we have the participant specific value. When we see participant specific value, as we discussed, participant specific value can be based on the, say the acquirers, the synergies and the specific, the specific things that the acquirer can bring on the table, like for example, the borrowing cost and the working capital, certain technology also he can bring in, which can be lacking over here. So there are several things. Participant specific value can also be found, and often when you have a business acquisition, the acquirer would want to see the participant specific value, because this is a commercial value. In commercial valuation, it is not about, shortchanging someone. It is about, what is the best price, what is the best level, that to which at which the acquirer can go and bid, so that, he is also, he's able to acquire the asset, and he knows that he has not paid extra. So it is quite, it's quite relevant, to find out participant specific value. And these bases have to be taken along with the premises. So participant specific value you can use with highest and best use. You can also use with the going concern value also, that also you can use. And fair value obviously you can use with, fair value is something which will go with the going concern, as is where is. In fact, even in orderly liquidation, you may look at the fair value of the asset, or the, there may be an undertaking, there might be certain assets, you might fair value some bit of assets, there might be certain tangible assets. So in case of an orderly liquidation, it might be sum of parts kind of valuation also, which may be considered. There are cost approaches also which are relevant, which we'll come to later, which may also be considered. Then we have the liquidation value, and liquidation value, if you see, liquidation value is the amount that will be realized on sale of an asset or group of assets when an actual or hypothetical termination of business is contemplated or assumed. So Liquidation value is found not necessarily always when there is a definite liquidation, but it is also a hypothetical liquidation. For example, in case of IBC, it may not be that all the assets are getting liquidated, but you may find a liquidation value for the assets. Now, when you say liquidation value, there will be orderly liquidation and forced liquidation, forced transaction also. So when you have a forced transaction, then you will also take certain discount on your receivables, because it's possible that you will not get all the funds which are receivable from the debtors, because when they know the business is shutting down, there will be many people who will say that now there's a need to pay them. So these are practical aspects. So there are certain discounts that have to be taken when there is a sale of, say, a plot of land or something. It's a highly liquid asset. So if you give a discount, upfront discount, then somebody will buy it. Somebody who has some expansion plans on the cards and who's flush with funds will say, okay, I'll buy the asset if I'm getting at a discount. So in case of a forced liquidation, where there is an urgent need to just liquidate, get out of the business and the assets, and you may have to bring in certain costs attached to liquidation, like the discounts. And also there will be, say for example, there can be workforce which would be engaged. There could be there can be some litigation with the labor unions. This is very common. Whenever there is any stress in the company or business, then there will be lot of all these factors also which will come in. You'll have to settle them. You'll have to settle with the government agencies on several dues which must not have been paid. So all these things, so all these costs also will have to be captured. That is under orderly and force both. The cost obviously have to be captured, but in case of force, you will have to take certain discounts on the assets which are getting liquidated. Okay, so now we come to the analysis of the asset to be valued. I, in fact, talked quite a bit at length on this, I think, in the earlier slide. But I will just read out what is written over here. Nature of the asset to be valued, yes. Scope and purpose of valuation engagement. Yeah, okay. So this is important. This is not what I talked about earlier. So you will have to understand from your client as to what is the purpose for which this valuation is required. Sometimes valuation is required, say, for merger demerger. Now if the valuation is required for merger or something, then there are there is a concept of relative valuation which comes in. And in relative valuation, you apply similar yardsticks for valuing the entities which are getting merged, which doesn't mean that you are using the same multiples. I'm saying similar approaches, similar yardsticks for valuing the companies which are getting merged. So you will do the comparable companies multiple, you'll take the market price if they are listed. You might use a DCF if the data is available. You may even use the asset base, and apply certain multiples. That depends, what kind of data is available and what type of business you are looking at. So you will have to say, in a relative valuation, you will use the same approach for both all the companies that you are valuing for the purpose of, say, merger. And next, if you have, supposing the management is looking at selling out some part of its stake, then obviously the management would want to see what is the best case available. So there you will obviously use all these approaches. You will also use a DCF approach. You will also use a payback, to show as to what is the payback period that the acquirer gets, what is the IRR that the acquirer gets. So one has to understand what is the purpose for which your valuation is required. So that is why the scope and purpose is very important. Next, we have the valuation date. Absolutely important concept. I have seen valuation reports which have not defined the valuation date. That cannot be, because valuation report is only means it is uh, based on the information available at the time when the valuation is done, and it has limited period of means it is only relevant for limited period, because with changes in the market, with changes in the business, changes in the environment, economic factors, the valuation may not hold good. So you cannot have no valuation date written in the report and that valuation report is carried on forever. No, that doesn't happen. There is always a valuation date which has to be defined, and um, uh, depending on for what purpose you are doing the valuation. Say for example, if you are doing valuation for a say merger or something, then you would want to take a valuation date which is as close to the date of the board meeting as possible. In case you are doing valuation for say some transfer of assets which are to go to some regulators. In that case you may also look at valuation based on certain data points available to you, which may not be exactly very close to the date when you are giving the valuation report, but not be very far away, say maybe a month, 2 months or something. So you will have to define your valuation date, specify that in the report so that the reader of the report knows the validity of the report. And the regulators here are very clear on how long should the valuation report be relevant. That is why valuation date is very important. When okay, so one more thing I want to tell you here: when you say valuation date, and you say that valuation should be carried out to at a date as close to the board meeting as possible, do I mean that the board has to, or the management has to give you the financials as on the date of the board meeting? No. um, you have to maybe consider the market multiples as on means up to the date of the board meeting. You'll take the market price up to the date of the board meeting. When you are doing a discounting, you will take the discounting for the residual period going from the date of the board meeting till the end of the first projected year, and the second year on will be all it will just flow based on the full year discounting built on the first year discounting. So valuation date is very important. Next is the intended use of valuation, which I think is it would also get captured in the purpose call for the valuation. Applicable valuation standards for of ICI, which obviously we have been discussing. Assumptions and limiting conditions are very important here. It will also get covered at length in your session where you will be discussing the documentation, reporting and limitations, assumptions and limitations. It's very important that you document this very clearly upfront in the report. There are certain limiting conditions, there are certain assumptions that you have to take. You will rely on certain data, and you will have to make it very clear that you relied on this data, or you have relied on the market conditions up to the valuation date. You will say that you have not really carried out if you not carried out a due diligence of the business, then you'll have to say that this is not a due diligence exercise, not valuation based on due diligence. It is possible that some due diligence might be carried out and you factored that those observations also in your report. Then you will also have to bring out that you have captured the observations of due diligence carried out by so and so. That also you'll have to write in the limiting conditions. Because why I'm saying is because what happens is sometimes the user of the report will say you are the valuer, and you would have captured all these things which may not be available to the valuer. The valuer may not have so much data points with him. He may have the due diligence report of some other professional, and he will take the observations from there and give effect to that in his valuation report. So that is why it is very important to bring it out that you have relied on this report of some other professional. So limitations and assumptions also are very important. While you are doing valuation, you will have to gather a lot of information, which we discussed earlier, the non-financial information also. Like for example, supposing there is a case where there is a rejig in the the management, and there has been, say, a P fund has taken over the company. So there are certain this kind of non-financial information. So you will have to capture all these things. So there might be comparable companies where you'll have very differing multiples. You might have to go dive into this and understand as to why there is a difference. The difference could be because of the ownership pattern also. Say for example, there are professional managers, there are PE funds, so they have a better interaction with the investors and market, and that itself will give a much higher value to that stock, and therefore the multiple would be higher. Where the interaction is lower, investor interaction is lower, then the multiple would be lower. So maybe you'll have to then in that case factor these kinds of things also if you are carrying out a valuation based on market multiples. uh, that's why the ownership details, financial information we discussed, you will have to see what has been happening, what are the ratios in the company, and then you will have to, apply it even to the future projections. You will also have to see the growth, compare with the growth of comparable companies. So that is all the financial information. And of course, general information will have to be also considered. I will give you example, like say for example, when COVID happened. COVID period was such a shake up for all the valuers because we were so much at loss. In fact, Professor Damodaran also, I think, had come up with beta mid-year, which he never would do. He would give his finding on the various country specific, not beta, but risk, ERP and the total risk. He would come up with only in January of each year. But because COVID struck, all of us went into such a spin that we didn't know as to what is going to happen in future. The market dived, and it was like a bottomless fall. So these kinds of factors also need to be then thought about. We have to see what has been the history, whether things will bounce back, what will bounce back, what will be a disruptor. So a lot of general information is also to be considered. So it is not about just playing with the numbers. It's not just playing with the numbers at all. It is about also understanding the overall perspective in which you are doing the valuation. Otherwise, your valuation will be challenged. Okay. Next, you have the adjustments of to be carried out to the financial information which is there. So I have discussed this part where, say for example, your company has surplus assets and financial data. Say the earnings will have to be adjusted for these say income from this surplus assets, non-operating assets. Similar adjustments you will also do for the comparable companies that you have taken. So let's see what all things are here. So yeah, okay. So same thing that we have to look at. Now, this is very, very, very important. I would say a lot of time goes in this process, which is identification of peer group, comparable companies. So we have databases which are available. So one has to first start with the first understand what exactly is the business of the company, what are the products which are sold by the company, and then you'll put a filter in your database of thousands of companies. You'll put a filter to find out which all companies are in this business. So you'll put a filter, you'll get a few thousand companies which are into that business. Next, you put a filter to find out the listed companies in that space, because all this you are doing to find out what will be the comparable set for applying multiples or for applying beta. Okay, so you will have to then find out what are the listed entities. After you come to that, you will also look at what is the comparability with your target. Say if your target's turnover is only say 500 crores, and if the comparable companies that you are looking at are in the range of say 5,000 crores or upward of that, it's like really it's a very different size of operation. So then you will have to keep this in mind, that these are companies which are much larger. So then a large company may not be subject to as much exposure and risk as a small company would be subjected to. And so then you may have to make certain adjustments to the multiples that are available from the the market. Clearly means one more thing I want to add here is that when there's a large company, it has a large shareholder base also. It will be widely traded, widely tracked also. And so in case of such companies, there is high liquidity. automatically such companies will also have higher multiple. And then when you have a small company, it doesn't have that much of shareholder base, because of which the company will not have that kind of trading, it will not be tracked much, and therefore you may have a lower multiple for that company. So you will have to do some sort of discounting if you are looking at comparing a large with a small company. Also, a listed company and unlisted company, will come to that liquidity discount also a little later, but you will apply a revenue filter. Now, it happens sometimes that you have a company which you are valuing which is small, and all the other players are very large. Would you reject all? No, you will not reject all. Then you will do a discounting of the multiple of the large players. But if you have a case where there are different types of players in the market, you have small companies, mid-size, large, then you will maybe apply a yardstick plus or minus 75% or something, and you will take the companies which fall within that range, and then you will take those companies in your comparability, and then you will analyze further. So this is what is very important. You do this. Next, you have to again do a business profiling for all the companies that you found. And when you do a business profiling, what happens is that in the database, they might have classified a company under a particular, segment and having certain products. But when you analyze, in depth, you see the company's financials, and you actually see the breakup of the products which are dealt in by the company, you will find that maybe the target's product is a very small component of the total revenue of the company. Say that is, say, just 10% or 15%. In that case, the company that you have looked at, which you got in the filter, is not a comparable. So it's a very lengthy exercise, but one has to do it, because this is very important. Once you do that, then you come to a final set, which is the list of comparables. Now, why this is very important is because anybody can, if you've not followed a scientific way of finding a peer group and comparables, it's very likely that at some stage, if there is any litigation, when somebody looks into the set of comparables, will find that there's a lot of bias which is built into selection of comparables. And so to avoid this bias, one has to follow a very scientific way of finding the comparables. Now we come to the various valuation approaches. Okay, I know that you have dealt with in depth yesterday on the valuation approaches, but again I will talk about this because in business valuation, again I'll just talk about it in the context of business valuation. So you have the market approach, you have the income approach, and you have the cost approach. So what is market approach? You know that market approach is market price, it is the comparable companies multiples approach, and it is the comparable transactions multiple approach. Right? These are the approaches which fall under market approach. Income approach is the DCF approach. You can even do a capitalization of earnings of 1 year. That also would fall under the income approach, because you are not applying a multiple based on any listed company or a transaction. It is based on the growth potential of your asset. It is based on the cost of funds of the asset. So in a way, I can say that the capitalization of 1 year profit would be very similar to your finding perpetuity value in case of a DCF approach. But this perpetuity value is found in on zero date. Next, you have the cost approach. So in cost approach, you have the replacement cost approach, reproduction cost approach. These are also, means we'll discuss at length what is the cost approach. In cost approach, you go with the asset base of the company, but you find out what is the replacement cost of those assets considering the obsolescence. So let's come to all these approaches and discuss in the context of business valuation. What's the time? Okay, so now we come to market approach, and in market approach, very, very, very important, I would say, market price approach. So When you're looking at, say, a listed entity and you are looking at the market price, or in fact, even sometimes you're not having a listed entity to value, but you have to look at the comparable companies multiple, and there again you have to look at the market price. Going to talk about both the things in the same breath. Okay. So when we see the market price now, COVID has taught us a lot, because normally people used to just blindly take market price for say 6 months or 3 months. Of course, market price of single day out of the question. You cannot take market price of the date of valuation, because that would be very, very incorrect. It is subject to too much of fluctuation, so you cannot really take market price of one single day. It should be market price over a longer period of time. And what is that longer period of time is what one has to take a call on, and it has to be well thought out. Say for example, when COVID happened, supposing you had to do valuation of a business when COVID happened. In fact, it was a very, very tough task at that time, because nobody knew in the beginning what will happen. What will happen to businesses, what will happen to the world. There were, what will happen to workforce, how will the supply chain get restored again. So it was a very, dark time for valuers, in fact, to carry out the work. But would you take market price of a shorter period? Would you take, in such a case, market price of a longer period? I would say I would go with a market price of a longer period in such a case, because I know, there is, even in the past there have been pandemics, things happen, they come to an end, economies revive. So it is not end of the world. It is not end of the world. So one has to then capture a little longer period, market price. Like for example, another example I can give you: war. If there is a war, when this Ukraine and Russia war happened. Now what happened? The moment the war the invasion was made, then the markets all over the world started plummeting, right? And there was, like, total chaos. In fact, I will say that we have not come out of it yet, because this has led to spiraling inflation. There are measures taken across the world, at least in India, for controlling the inflation. Again, the tightening of fiscal policy is being done, and it is a very uncertain time again because of the war. You don't know how long it will continue, how long will you have the supply side problems, which will lead to, like, higher inflation, and because of which the market is right now very nervous. So every day you find that the market is falling, right? But would you, if you were to do a valuation just around the time when the war happened, would you take market price of just the period after the war, or would you take it over a longer period of time? I would say it is ideal to take market price over a little longer period of time, because war will happen. War, hopefully, means obviously everybody hopes for that and wishes for that, that it will end soon. So when the war ends, everything will come back, the supply side problems will be resolved, and then the market will bounce back. What When we do a fair valuation, we are not finding, we are trying to find out a long-term value. When you find even a DCF value, you are trying to find out a long-term value. So even when you are doing a market price approach, you are trying to find out a long-term value, not a very short-term value, because it is for a transaction. Say when there's a merger happening, you don't want to give just a short term value, and decide on the ratios, because the shareholders have invested in the companies for long term, supposing they would not want to look at the short term value. So there can be times when the price, which is fair value, which is determined for the purpose of merger, would be different from the prevailing market price. And of course those things do happen, but that's how, that's where the valuer's judgment really come in. And valuation is a very, I would say, one has to use a lot of judgment, and judiciously one has to do valuation. So market price is a very important concept, and you have to decide on whether 60 days, 6 months, 3 months. uh, you have to look at the market price depending on the events around the time when you are doing the valuation. Now we come to the CCM approach, which is based on the comparable companies multiple, which is also the guideline public company method, where you value the asset based on the market multiples derived from the listed peers. We saw how the peer set is found, and when you have to find the comparable companies multiple, the other factor, the most important factor, is to come to a proper period for the market price also. So if you finally decided that the better period for me to take is 6 months, and for all the peer companies you will take a 6 months market price and arrive at the relevant multiple. We'll come to the relevant multiple in next few slides. Next, you have the comparable transaction multiple method also. Again, here you cannot really do anything. It's basically the price at which transactions are happening at that time for those types of assets. Say, for example, there was a time when there was a relaxation in the Reserve Bank of India's policy, and it relaxed to increase the holding percentage of the foreign investor in asset management companies. So immediately the Indian holders sold out some percentage to the foreign investors, JV partners for those AMCs, and there were quite a few such transactions which even happened in insurance business, AMCs, whatever. So you can then look at comparable transaction multiple also. All It's a good method, no doubt, because in a way it would be based on long-term value of the asset which is perceived for the purpose of the transaction, and you will apply a multiple based on that, taking certain parameters such as the earnings or the asset or the capacity. All depends, what kind of asset you are valuing. Now, when you take a comparable transaction multiple method, the only difficulty in this approach is the data, availability of data. So the reported data may not be adequate for you to find out the exact multiple. So how much ever data is available, you might be able to find out some multiple, and if you are able to get good quality data, then maybe that multiple will be reliable. Now we come to the multiple based approaches, which I'm sure are discussed, but I will again discuss with you. So what are the different multiples? One is the EBITDA multiple. Now what is EV to EBITDA? That is enterprise value to earnings before interest, depreciation, tax, amortization. Okay, so that is EBITDA. This if you see, numerator denominator concept is very important. That is, numerator is inclusive of all the sources of funding, which is debt and everything. So EBITDA is also earning before interest, depreciation, tax, and amortization, and you will come to a multiple. Now this is it's a very good yardstick for comparing companies, because here you will completely iron out the leverages between the companies. Say for example, if one company is highly levered, say not highly, but I'm just saying, supposing one company has a leverage of say 60%, and the other company has a leverage of 30%, then only 30% levered. Then in that case, an EV EBITDA multiple would be a good way to value, because you are kind of just ignoring the leverage. Of course, I will not say that there is no impact of leverage on the equity value. Equity value also sometimes gets affected if the leverage is not sustainable. Then in that case, equity value also gets affected, and also it depends, means equity value also gets affected by the pledge of shares by the promoters because of the leverage. So all these things, you have to keep your eyes and ears open. You have to collect all the data and interpret and use it judiciously. So that is the EV EBITDA approach, highly recommended, a very good approach in comparable companies multiple approach, where earnings approach is a way to go. Next, you have the PE multiple, that is price to earnings. Now, what is PE multiple? There you take the PAT and you take the market cap. You are not taking enterprise value, you are taking the market capitalization, and you are taking the profit after tax, PAT, of the companies. Here, if you look, you plot all your comparable companies and you see the EV EBITDA and you see the PAT. By just looking at the divergence between the companies' PE multiple and the alignment in EV EBITDA multiple, you will be able to tell which company has very high leverage, which company has very high, depreciation. So all these things can be very well observed. Now, ideally, you will take when you take P multiple, if there is very differing leverage across the comparable companies multiple comparable company set, then ideally take the EV EBITDA multiple, because then it may not be comparable and also not comparable with the target. So better to then use EV EBITDA approach. But if you are able to establish that okay, everything is in range, the leverage of the the peer set is in range with your target, then maybe you can use the PE multiple approach also. There you straight away get value for the equity holders. Now another thing is, in PE approach, you will also not be able to make an adjustment for the tax. So it is possible that in a particular jurisdiction you will have different types of tax slabs available. There can be favorable rates for certain types of companies. There might be certain exemptions, deductions available, because of which the effective rate of tax is lower. Now all these things may not get factored into in PE approach. So you have to see as to like where the comparable companies stand, whether they enjoy similar benefits, or is your target also enjoying those benefits as comparable companies. You'll have to see and use P multiple with a more with greater caution. Next we come to PB multiple. Now PB multiple is price to book multiple. Now you say what is the use of price to book multiple? But where there are certain businesses which are valued on the basis of the assets. Okay, like say for example NBFC company, NBFC which is fund based, that is lending NBFCs. So if there are lending NBFCs, in that case they will have a sufficient, they'll have a good asset base, and their valuation must capture their book value. So there can be loan book also, there can be net worth also. One has to capture all that. That will also again these are very different concepts which have to be used in case of NBFC. We might have to also see the efficiency in deployment. In case of NBFCs, you have also the efficiency in deployment. Banks will have efficiency in deployment of your funds. So all these things have to be seen. In fact, these things have to be seen at the time of establishing comparability itself, and accordingly your PB multiple will be different between the comparable set. So this is PB price to book multiple, which is also very important. Next you have turnover multiple method. Now turnover multiple method is a little bit, it doesn't capture your the profitability or anything. It doesn't capture tax benefits, tax breaks, profitability, leverage, nothing. It doesn't capture anything. But it is pure multiple based on turnover. Now these types of multiples may be relevant when you are doing valuation of retail companies. In case of, in fact, retail companies which are into retail space, even there are various other multiples benchmarks also which will be relevant, but turnover multiple will be also very important. Of course, EV EBITDA is a very good way to value, but turnover multiple also should ideally be seen, because different business models can be adopted, and you can actually build in a lot of efficiency into businesses. So different businesses have different ways of functioning and build efficiency. So when you have certain penetration in the market which is reflected in your turnover, in case of retail space, it is a very important yardstick, and so you can use this multiple. Okay, now the next thing is you will use normalized earnings or asset base for the purpose of, arriving at value under the different approaches. Again, I'm giving you the same example of COVID because I think it's a fantastic example to give for a value, because you know that there are instances when suddenly everything comes to a standstill. There are no earnings. There was a company which was probably making thousands of crores of profit. Suddenly it goes into a loss situation because of unutilized capacity, lockdown, and so many factors which play out. So one has to, when you do valuation, you will have to apply these multiples to normalize earnings. That is, then you will have to see, okay, that going forward, say what will be the earning of the company, what will be the EBITDA, what will be, so that for that the management will have to come up with their estimate of what sales they will have, what kind of profit margins they will be able to earn, because there are different business models which have come in, and so there will be there's an impact on the margin also. Again, there are like for example war, which has really affected the margins of the companies because of inflation. Now, would you say that this will continue forever, or would you like to, make an adjustment for that? But when you are looking at companies at the same time, it is possible that all the companies would suffer in a similar way. So if you're applying a multiple based approach, comparable companies multiple, the comparable companies would have also suffered in the same way. Their margins also would have gone down. So means you will have to always keep on looking at, in a very relative fashion, your target company and the multiples that you have with you, and the market situation. Now supposing you are looking another thing, say you are looking at say your target which had a strike in the earlier year and the profits are low, you're doing a valuation for that target. Would you consider the profit of the earlier year, because the strike would have really dampened the profit? Would you take that profit, or would you take a normalized profit? Because when you are finding out a long term value, you will go with the normalized profit. So all these factors you have to keep in mind. You normalize the earnings, you normalize the asset base, and you arrive at the value under the various approaches. Another thing, as I discussed earlier, was that the growth rate is also very important. Ultimately, when you say this is the market multiple of a company, that market multiple automatically captures the growth of the company, and that is why when there will be certain companies which are in high growth phase, a listed company supposing, for which the expectation is that it will grow very fast, and the target that you are valuing, will not have that kind of growth for certain reasons, then in that case you might have to do certain discounting, or you might have to take a peer set which is comparable having similar growth. So growth is very very important when you are taking the multiple based approach. Now we come to the adjustment to market capitalization. See, we made all the adjustments to the earnings, we made adjustments to, say, the assets. Now, when you done the adjustments to the earnings of your target, you will have to do similar adjustments to the comparable companies that you have selected. Now, comparable companies, for the purpose of multiple, you would have taken the market capitalization of those companies. Now, you'll have to look at each of those companies. They will have their investments. You have taken out the non-strategic investments from the company for the purpose of valuation, supposing. Then, for the purpose of the comparable companies, you might also have to, if there are non-operating investments not in the course of their business, but something very different, these are non-operating investments, then in that case you will have to make an adjustment. But what will be the adjustment? It's very important to understand what will be the edge, because see, say for example, I'll just give you an example. It's very important to understand this, that say market capitalization of a company is, say, I would say 10,000 crores, okay, and that company is sitting over investments of say 1,000 crores, and it also has good business. Now when you do the valuation of this company, would you reduce from 10,000 crores the entire 1,000 crores of investment, or would you take a discount? So we have seen empirically that market gives a discount to the underlying investment. Market does not reflect in the market price the entire value of the underlying investment, and so you will have to capture some discount also. So in India, there are different, rates of discount which are adopted, 20%, 30%, for listed entities. These are all available in analyst reports also. If you can, get the analyst reports also, you will see in case of listed space where the analysts have done a detailed sum of the parts approach. They will also tell you what kind of discount they have adopted for the underlying investment. So underlying investments suffer a discount, and so you will adjust the market capitalization of the comparable company for the investment value after considering certain discount which is seen in the market, because ultimate aim is to find out the multiple for the operating business, and we cannot really get distracted with all the non-operating factors which have a reflection in the market price. So we have to eliminate all those factors. So this one is investment. There can be other surplus assets, there can be huge amount of cash. Now there will be different, because everybody has, every company will have a different treasury outlook. Companies sit over different levels of cash. So the better way to do is, to eliminate even the cash from your market capitalization, the surplus, not the operating cash. So cash which is sitting in current account and all, you may not really eliminate, because that's purely for the purpose of, day-to-day functioning of the company. But there would be FDs and, long-term cash and cash equivalent like mutual funds and things like that. So all those things you will have to eliminate from the market capitalization. Now there are surplus assets also, like for example, if there's some old company with a lot of land sitting in the company, you will, in case of that listed company, you will find, that analysts would have given certain reflection of the value of that land which is sitting in the company in the market capitalization. So say for example, in this 10,000 crores market capitalization company, if you have land, a huge tract of land, say 2,000 crores the value of that land, then would the market capitalization be reduced by 2000? May not be, because the analyst would have given some discount. You cannot really sell out the land and cash the land immediately. So the realizable value of land will be much lower than 2000 crores, because it will take time value of money also will have to be factored in. So there will be certain discounts. There will be certain discounts on account of the taxes which have to be paid, the charges which have to be paid. So all those discounts, after applying the discount, there would be, you will come to know like what kind of discounts analysts have applied, and which is the market sentiment, and you will have to make that adjustment for that surplus asset from your market capitalization. Okay, so next we have the income approach, which is, as I said, DCF approach, income capitalization approach also according to me falls under this, and it is possible to do this. What would you use this DCF approach for? You will use it for certain types of assets, like say for road asset. Road asset valuation should be done based on DCF approach. You have the traffic assumptions, because all these things are part of your filings, right? So there will be detailed assumptions on various things like traffic, tariff, many things, the O&M expenses, all these things would be there in that projection, long-term projections for the entire period for which the road project is awarded to the target or the comparable companies would be available. So you can, sorry, not sorry, target would be available, and so you'll have to take the entire period's projections, and you will have to then find the value, which is a lot like an annuity value. Now I will just discuss a little about, what are the key factors which have to be considered for the purpose of your DCF valuation. So one is risk-free rate. Again, risk-free rate, very, very important for us, because uh, India also has always had a cyclical risk-free rate. There is a tightening, there is relaxing of the monetary policy. So many things are continuously happening. If you see, there's a lot of cyclicity. So if you were to just take the current risk-free rate and apply it over the entire period of the projection, would it be correct? It may not be correct. You will have to take a call on like what is the likely risk-free rate. Maybe you'll have some guidance from the average of the past periods risk-free rates to build into the projected years, so that you can get a risk-free rate which can be applied to the projected period, because by then the interest rates will start softening down and your risk-free rate will come down. So right now it might be higher, later it might come down. So risk-free rate you'll have to consider with great understanding. Next you have the ERP. Again, that is equity risk premium of the market. Now equity risk premium you can compute also. You can compute based on the difference in the return that you have earned on the equity market and the risk free rate for various periods, a long period of time, say 10 years, 15 years, ideally 15 years you can take if there is depth in the market. You can also take guidance from databases like Professor Damodaran's database, which is available for free. That also gives very good insight into building the uh, equity risk premium of the market, uh, based on the bond volatility, and the total risk premium of the market, and you can actually build the equity risk premium of the market. Next, you will also now you'll also have to consider the debt equity. Now, your target will have certain debt equity, and you have say the comparable companies in the market for which you've taken the beta at certain debt equity. So you will have to take a call on whether you will go with the target's debt equity. If the target doesn't have a long-term outlook on debt equity, you might align with the industry debt equity, right? And you will align with the industry debt equity, maybe build into perpetuity that industry debt equity. So debt equity also is a factor which has to be seen very, very judiciously, because you'll have to take your call. It's possible that the company is not really, it's very averse to debt, but has debt. It is going to repay over a period of time. You'll have to build it into your WACC. Why that debt equity is important? It will be built into your WACC. But if you have a model which is very dynamic, and your weighted average cost of capital and your levered beta are completely aligned, then your weighted average cost of capital will stay in a certain range only. Okay, so you can test it on your Excel model very easily, and you'll be able to see this. Next, I want to talk about in case of DCF, I want to talk about the perpetuity value. So now perpetuity value has to be based on the last projected year, or yeah, because you have to have something to start off with. So say you have the last projected year, but in the last projected year there is some, like there is very inadequate capex, maintenance capex or something. Then when you are building the perpetuity year cash flow, then you will have to take the maintainable level of capex. Then you will also have to see, say, working capital level. What should be the working capital level, which is maintainable? So all those calls you'll have to take. Tax, because it is possible that the companies are enjoying certain tax rates, tax benefits, and that window is going to get over in some time. So maybe in perpetuity you'll have to take the normal tax rate. You might even have to build the present value of the tax benefit which is unexpired. So all those things you'll have to bring in. You'll have to see even the EBITDA which is maintainable. So quite a few such things you'll have to build in for your perpetual cash flow. Next, you have the WACC, as I told you, that you'll have to take the risk-free rate. And most important is that, sometimes over the projected period, you might have very high beta for your comparable companies that you are using. And then you would have a question whether that high beta can continue, or that low beta can continue. So the concept, the principle, or I would say the theory is that in a long period of time, over a long period of time, the beta of the companies in the market will always converge to 1. So you will have to select a band of beta, say 0.8 to 1.2 or something like that, and you will have to organize your beta in perpetuity to that range. So you'll have to take all these factors into account for the purpose of your DCF valuation. I can't go too much in depth because I'm running out of time, or I have time. I am running out of time. Yeah. Okay. Next, we have this. What are these premiums? That premiums or discounts, that you have to consider for the purpose of your business value. So it happens that your business is, as I discussed, that your business is a small business, right? So it is, in case of DCF, how will you build the small business, how will you factor the small business, specific into your valuation model? So then you will have to build it into your cost of equity, because it's a small business, it is more risky compared to a bigger business where, say, the beta is much lower, and you will have to then peg the beta a little higher, or you might have to then, in the overall cost of equity, you will build a premium 1%, 1.5%, for building this risk attached to the size of the business. Similarly, other factors, I've just listed a few factors like small customer base. Say if the company is deriving like 90% of its revenue from just 10 customers, that's a very, very dangerous situation, because we are looking at huge exposure, just few customers, impacting the entire business of the company. Anything goes wrong with even two customers, and your 20% of the business will probably be wiped out. So that's a huge impact. You will have to build a premium, even for this small customer base. You will have to use your judgment and build a premium. So generally you take a 1%, 0.5, 1.5, and this you will build after you come to the cost of equity based on the beta of the comparable companies, the risk-free rate, the ERP of the market, and after that you will come to, say, a cost of equity. Now your, say for example, I'll just give you an example practically how it happens. You come to a cost of equity of, say 12.5%. You will say, oh my God, this is so low. Like if I were to invest in this business, I would not look at a cost of equity, or means I would not look at a return lower than 15%, right? And then you will try to analyze as to why would you say that the cost of equity should be higher. Then you will see various reasons which would be there, that there is size, there is customer base, all those things. So uh, you will then build this into the model. Next you have the cost of debt, where you, in case, this is just one highlight that I have brought in here, which is foreign currency borrowing. Please ensure that you just don't take the cost of borrowing based on the cost of borrowing in that foreign currency, because the country specific risk is not built into that. You will also have to do a interest rate parity, and you will have to bring that interest rate. What is interest rate parity? I'll just explain in short, in a very short time. Interest rate parity basically only builds the, I would say, the country risk, and the country currency devaluation risk, which is there in the currency in which you are valuing, into that interest rate in foreign currency. Okay, that is the interest rate parity study that you do. So you do the foreign currency borrowing also. You will kind of again restate at the rate of interest in your currency of expression. Okay. Then you have the cost approach, where you will do the replacement. So what is the cost approach? Basically it is the amount that would be required currently to replace the service capacity of an asset. Okay, so that is a replacement cost approach, and in that you basically find out what the market participant will have to incur to uh, replace that asset, considering the obsolescence, after considering the obsolescence also. um, Reproduction cost is for a replica of the asset, and replacement cost is really for a similar asset. So there can be a little difference, because with passage of time, obviously there could be change in the technology, or so there would be a replacement cost approach in such a case. Then you have the liquidation approach, where you will see what will be the value, what will be the amount that will be recovered if the company was to, or the business was to wind up. This can be used in case of family settlements, shareholders disputes. These things can be obviously, and then the real cases of the liquidation also obviously would require you to use the liquidation cost approach. Two factors here that I thought we'll just talk about: the liquidity discount, very important, and control premium. So where you are valuing, say, a target which is not a listed company, and you have valued the equity shares of that company, then you will have to also build in a discount, because the comparable companies multiples that you have taken are all in listed space, and that is why there is no, there is a lot of liquidity. There is that benefit of liquidity which is not there in your stock, and so there will be a liquidity discount which will have to be applied to the equity share value of the target company. You can also have a lot of deliberation. I don't want to get into that deliberation, because that can be, as Parag has now just entered the arena, I know that this control premium can be a very big area of debate, and there are schools of thoughts which say that DCF approach has a built-in control premium, because market would not be aware of certain data which the management has, and DCF is based on the management projection. But in my experience over last few years, I have seen that the DCF value invariably, I find, is in a lot of cases, it would be not very different from the market price or lower than the market price. In some cases, of course, where there are certain things which have to be considered, there will be projections which will bring in the true value, and there the DCF value can be higher. But control premium is, there's a wide range of control premium, ranging from 5% to 35% also. So one has to then see, it's a negotiated kind of an arena. We have to see what control premium could be applied. But it's a highly debatable kind of an area, and so it's more on a on commercial basis that one has to see the control premium. Valuation under liquidation, I have already talked about. Non-operating assets adjustments also I have already talked about. The only thing that I'll just touch upon over here is the intercompany investment. So if there is substantial investment in another company, then you will take that investment at you will have to take it at fair value. You will not obviously take it at cost. Even if that company is listed company, you will take it at probably fair value. You will have to apply the same approaches, and then you will take it at that fair value into the value of the target that you are looking at. Capital structure is again something that we have talked along the entire process. Now we come to the last thing, which is the benchmark value and rule of thumb. So just to give you an example, there are certain businesses like, say, telecom business. Then you have say certain types of manufacturing, like, say, cement capacities and all. So there are certain benchmarks which are laid down in that, and benchmarks are based on various parameters. Say, in case of telecom, it is ARPU. In case of tower, it can be tenancies. In case of cement, it can be based on capacity. So all these different parameters are there, and they are based on, in a way, one can say, based on the long term value only. But it is a good thumb rule to check whether your value that you have arrived at is within that benchmark or the parameter which are there. And then we come to the final slide, where you have the values under all the approaches. And then it is your turn again to see as to what weight you want to apply to which approach is not appropriate. You will have to give a reason why a particular approach is not relevant for the exercise, and then you will have to come to value based on maybe an average of all the values that you have come to, or you may be required to give a range of values. So once you come to this level of having found the values, and it is for the valuer to apply different weights and or give a range of values based on the approaches. So I think that's it from my side. And Yes. So that's it from my side, and I hope I was able to cover everything that was given.
Thank you, madam. Thank you, Shri Drushti Desai, for your very insightful session. Of course, valuation is a very broad area, and the objective of this course is to provide basic insights on the valuation and valuation standards of ICI, so that our members could have some concepts or ideas on the valuation approaches, methods, assumptions, and some standards, so as to standardize the valuation practices carried on by our members in our country. Saying this, once again, thank you so much, madam. We have already next session will be taken by CA Paragved, and he has already entered the session. I would like to welcome him, and I'll give a brief introduction of CA Paragved. CA Paragved is a practicing chartered accountant with more than 20 years of experience. Parag is founder partner of SSP and Company Chartered Accountants and is involved in corporate consultancy practice of the firm. Parag's primary areas of practice are valuation for mergers and acquisitions, advising on restructuring of business, conducting financial due diligence, and general corporate advisory. Parag has been associated with several large corporate mergers. Parag is a regular speaker at the Institute of Chartered Accountants of India on various subjects, including merger acquisition, valuations, due diligence review, etc. Saying this, I like delivering lectures on practical case study on valuation. Now, I would like to request Parag sir to take up the session. Thank you.
Thank you, sir. It's my pleasure to get associated with Institute of Chartered Accountants of Nepal. And Dustin, I also heard you, so it was a pleasure hearing your thoughts. Of course, I could join very late, but it's always a pleasure to hear you. I'll just share my screen. Is my screen visible, sir?
Yes, we can see it.
Okay, thank you. So today, I'm going to take this case study on valuation. Of course, I'll very briefly touch upon the very valuation concepts. I'm sure that other speakers have previously dealt with this. I'll just share my views in this. So I think the most important is there is a difference between the value and the price. As a valuer, what value we arrive, not necessarily the transaction also will take place at that rate. There are various factors, which the promoters or the shareholders will keep in mind. Like say, for example, if somebody wants to exit at any cost, they may even exit at lower value, or somebody want to pay a premium, they are open to do it. So what we give is maybe sometimes a basic indication for them to start a discussion, and then depending on the willing buyer, willing seller situation, they will decide how the transaction will go through. Valuation is not an exact science; it is more of an art. It is date specific. So always in our valuation report we write what is the date with which we are doing the valuation, what are the cutoff numbers which we have taken, because sometimes there could be in today's dynamic world, a lot of things keep on changing. Very recent example, say this Ukraine war. Now, if somebody has done a valuation of any company where crude is a raw material, say before 4 months, now the entire thing has changed. Crude has almost gone up by 40-50% from the rate at which it was available. So always it is better to write in the report that what is the date with which we have done the valuation, and obviously any changes which are taking place after that date, the valuation may not hold good. The valuation is subjective depending on like say there are 200 chartered accountants in the room, give same data, everybody will come with a different number. And value varies with situation. The purpose for which you are doing a valuation, your methodology or approach may change. Like say for example, you may in a deal, you may sometimes represent the buyer, or sometimes you may represent seller. Now, if you are representing buyer, always you will be very conservative in your approach. But if you are representing the seller, you will be optimistic. And then both buyer and seller valuers will give their value to their respective clients, and then clients will negotiate and arrive at the value at which the ultimate transaction will take place. What are the purposes for which valuation has to be carried out? Business valuation is for restructuring, like say merger, amalgamation, demerger. For those purposes, valuation will have to be carried out. Purchase and sale of share or business, one will need a valuation. Litigation and family settlement, one may need a valuation. Fundraising, again, you may need a valuation. Regulatory, like say in India we have FEMA. I believe similarly you have a Foreign Exchange Regulation Act in Nepal. So if under that, if valuation is required, under income tax, if it is required, then if Security Board of Nepal wants valuation, or Nepal Companies Act. So again, I don't have much idea about how the regulators look at valuation in Nepal. But in India, certainly we have, and I'm sure some kind of similarity even Nepal may also have in terms of regulatory valuation. Then coming to the intangible valuation, you will need a valuation for purchase and sale of intangible. Then hypothecation of the intangible. Like say there are so many transactions which take place where valuation will be required for the purpose of like say somebody has a brand and they want to raise loan against that brand. So they will hypothecate that brand with a banker, and against that banker will give the loan to them. So for that purpose, valuation could be required. Accounting for purchase of intangible, you may need a valuation. And impairment testing also. Once intangible is there in your books, you will need a valuation for the purpose of intangibles. Financial reason could be purchase price allocation. Like suppose if you purchase a business for a particular amount, and obviously the book value of assets liability is going to be much lower. So the one has to value the assets and liabilities acquired at the fair value. At the same time, if any intangibles are acquired in that, that also has to be valued for the purpose of your financial reporting. And normally the difference between the assets and liabilities acquired, if something still left, it will go to the goodwill. Then if any PE funds or venture capital funds are investing, then you will need a valuation. You may need a valuation of financial instruments for the purpose of, again, financial reporting. And finally, even for your fair value accounting also, you may need a valuation and impairment testing. Very briefly, I'm sure this has been already covered. So ICICI Valuation Standards 2008 in India are applicable, and ICI RVO has adopted these standards. In India, now valuation is governed by the government authority, which is IBBI. Under that, there is a concept of registered valuer, and they conduct the exam and then they give the certificate for you to practice as a registered valuer. Briefly, these are all the valuation standards. Again, I'm sure that somebody has taken up this. Coming to valuation basis and premise, it is indication of the type of value being used in an engagement. Different valuation basis may lead to different conclusion of value. There are like fair value basis is there, liquidation value, as Ms. Dushri Desai just now mentioned, could be there. Participant specific value could be there. And there are also other bases of value like relative value for merger, demerger, agreement and arrangement between the parties. And if any statute is prescribing any valuation methodologies, then one may have to use those methodology which are prescribed by any government regulation or statute. Now, coming to premise of value, it refers to the conditions and circumstances of how an asset is deployed. Some common premises of value are, HABU, which is highest and best use. This is the you use for a non-financial asset by market participant that maximize the value of an asset, and it is physically possible, legally permissible, and financially feasible. Basis varies basis also. Sometimes valuation could be required, where you will look at the existing use of the asset, which may or may not be its highest and best use. Orderly liquidation, again, Ms. Dushri Desai mentioned, so it could be there. Forced transaction, if it is there, then where seller is under constraint to sell an asset without appropriate marketing period or effort to market such asset. Sometimes, in a transaction, a seller is forced to carry out the liquidate the asset, so he doesn't have much choice, and he has to then carry out the he has to sell his asset. Going concern value is a value of a business that is expected to continue to operate in a near future, in the foreseeable future. And single or multiple premises of value can be adopted depending upon the facts of the case and the purpose for which one is doing the valuation. Coming to business valuation approaches and methodologies, I'm sure again this has been discussed. So there is an income approach under which you have a discounted cash flow method. Then under market approach, you have market price method, comparable companies multiple method, and comparable transaction multiple method. Under cost approach, you have net asset value and replacement value or realizable value method. What are the factors which will keep in mind while selecting what valuation approach you have to use? So key factors for selection of valuation approach are valuation basis and premises, nature of the asset to be valued, availability of adequate inputs or information and its reliability, strength and weakness of each valuation approach and method, and valuation approach and method considered by market participants. Like say, for example, if I'm valuing a say a investment holding company. Now, investment holding company may not have its own business, but it has a significant investment in other operating companies. So I may have to value the investment holding company using the cost approach, where I will take, but in that I have to take the underlying value of the operating business. So operating business I may value based on the DCF or a CCM method. Take that value to the extent of your holding into the investment holding company. So those kind of typical companies may need a different valuation approach. So no one can say that this is the only approach, method which is best suited for valuation in every situation. Each situation and the circumstances may demand for you to do a multiple approaches of valuation, and then you may have to decide based on the the outcome what you get, which is the method to which you want to give weights and how you want to do it. And if one is using the multiple valuation approach and methods, then the results will have to be evaluated considering the range of values indicated by those results, and then either you take a particular value, particular method, or you may use a combination of methods and then arrive at the value. Coming to income approach, the discounted cash flow method, it values a business based on the expected cash flows over a period of time. It considers cash flows and not accumulated accounting profit. Value of business is aggregate of discounted value of the cash flows for explicit period and perpetuity. So perpetuity. So in any business, what you do is you project for next say 5 years or 7 years. Now beyond that, you may not be able to project, because beyond that, any case, it is going to be an arithmetical assumption. In fact, I would have done so many valuations in my life yet to see a projection which is actually achieved. So everybody will project that I'm going to grow, I'm going to beat the market, I'm going to beat my competition. But in reality, it may not happen. So many things, which are beyond the control of the management, it can happen, and it can, your projections can go for a toss. So one will have to always keep in mind and take the projections with the pinch of salt. And the DCF method involves determination of discount factor and the growth rate for perpetuity. What are the parameters which you will use in the DCF? First is the cash flows, and then the discounting rate. So cash flows, you take the projections. There are two approaches: FCF to firm or FCF to equity. So free cash flow to firm or free cash flow to equity. As I said, you project for a explicit period or horizon period, a period for which you can see that how you are expected to perform. And after that, you assume that the business will continue in perpetuity. So you apply a growth rate for perpetuity. Again, when you do a perpetuity or terminal value, there are various methods. Either you apply a growth rate or you apply a terminal multiple, exit multiple to the cash flows of the last year. Once you have the cash flows in place, then you need to also decide what is the discount rate which you want to use. I think Drushti has already dealt with this. I will also give my views on this. So there is a concept of cost of equity and cost of debt. And depending on how the business is funded with equity and debt, you have to determine the appropriate debt equity ratio. So when it comes to the cash flows, for enterprise value, you will take gross operational cash flows, that is EBITDA, minus tax, minus working capital requirements, and the capex. So, like say for example, if you're doing any method which is accounting related, then a profit which is booked, which is accounted in the books will become a base. But suppose if you have sold the goods, but if you have not realized the money, then that will go and sit in your working capital. So to that extent, it is going to block your cash flow. So in cash flow, you take the DCF method, you take EBITDA minus tax, minus working capital requirement, and minus the capex. Now capex also, you may have a maintenance capex, and you also may need a growth capex. So depending on what kind of growth is projected, one will have to decide what kind of capex is required. There will be certain industries where you may need a regular maintenance in terms of suppose if you are manufacturing, you are a manufacturing sector, and you are manufacturing say chemicals which are very hazardous. Now because of hazardous chemical, there will be very high wear and tear of your plant and machinery, and equipments. So then one will have to, while you may get accounting profit, but a lot of that you may have to reinvest in terms of to keep your assets working and alive. So that capex requirement has to be projected. So these are the parameters which are used to work out the FCFF method, and you discount by the WACC, which is the weighted average cost of capital. Having worked out the cash flows for FCFF, then further adjustment can be made for interest payment and addition and repayment of loans, and this you use it for the FCFE, that is a free cash flow to equity shareholders, and you discount this with the cost of equity. In theory, whether you do a valuation under FCFF or you do under FCFE, the end result should be the same. But in reality, we find that always there is a difference. So practically in 95 or 98% of the cases, we use FCFF method. Very few cases we use FCFE method. Now, once you have the projections, then you also need to decide what is the discount factor which you want to use. So ideally, there are 2 or 3 ways of finding the discount cost of equity. Like say, for example, if you are doing a valuation for an investor, and if investor says that his return expectation is 22%, then 22% will become your cost of equity. You don't have to go into any other methodology. But if investor says that I don't know what is that I should expect, then you will go under the capital asset pricing model, where cost of equity is equal to RF, that is a risk-free rate, plus market risk premium, market return minus risk-free rate. So you get a market risk premium, and that has to be multiplied by a beta. So beta is a sensitivity of a stock vis-a-vis the overall market. Then like cost of equity, you may also have a cost of debt. So here you'll have to find out the rate at which the firm can borrow money, and will depend on the default risk embedded in the firm. There are possible sources of information for cost of debt. That is the cost of debt currently incurred by the company, and current market cost of borrowing incurred by comparable companies that have a similar credit rating. So sometimes it may happen that your company is fully funded with equity, and but normally if you look at the other comparable companies, their businesses are funded through equity and debt mix. So maybe to find out the value, you may want to look at what is the target debt equity ratio which investor will look at, rather than looking at the firm specific the funding of the business. So discount factor, the weighted average cost of capital is that is D upon D plus E into cost of debt. So that is debt upon debt plus equity into cost of debt, plus E upon debt plus equity into cost of equity. So basically you arrive at the cost of equity and cost of debt, and depending on how your business is funded, suppose if your business is funded 70% by equity and 30% by debt, you take give 70% weight to the cost of equity and 30% weight to the cost of debt, and based on that you arrive at the weighted average cost of capital. In the subsequent slides, I'll show you the exact examples of this calculation. So enterprise value in the case of a DCF is the future cash flows during the explicit period. So present value of that plus present value of the cash flows for perpetuity. Like say, for example, if you're doing any valuation of any business, say you're doing a valuation of Unilever Nepal. Now, Unilever Nepal, one will assume that it will continue for foreseeable future, but your projections are only for 5 years. After that, what? So after that, there is a concept of perpetuity value or terminal value. So the summation of both present value of cash flows for the projected period plus present value of cash flow for perpetuity will give you the enterprise value. Now this is, I just prepared some sort of summary numbers. So like say, when you do analysis of and you do the DCF method, you also look at the past, how in the past company has done in terms of its profitability, how much growth there is there in the sales, what is the cost of goods sold, how much gross profit they want. Then there are other overhead cost like employee cost, electricity, rent, or any other cost which the company may have. So based on that, you'll arrive at the EBITDA, and from EBITDA you will reduce the interest and depreciation, so you'll have PBT, and from that you remove the tax, so you get a PAT. So basically this is how your business plan will look like. So if you see in this slide, the first three columns are the actual which company has achieved, and the year 78-79 is the provisional year, which I believe could be the current year, and then your projections for next 3 years going forward. Now here, if you see that the cost of goods sold in the past for the company is 75%, whereas in 78-79 they have achieved 74%, and maybe management is projecting that in future they will make it 74% and then 73%. So this reduction in cost of goods sold may come through a combination of various factors. It could be like, say, for example, you are able to increase your market prices of the products what you sell, and there is no corresponding increase in the cost. So in that case, your gross profit margin is going to increase. Or you may have a you are able to procure raw material at a at a reasonable price, or there could be some saving in the manufacturing cost which you may incur. So there could be various factors, and it could be combination of all these factors, which is going to give you a lower cost of goods sold and higher gross profit. So from the gross, so if you notice, gross profit in the past is around 25 to 26%, and in the projected period, it is expected to go up to 28%. Then you have other overhead cost, and some of these costs also could be like, say, fixed cost. So it may not be related to the growth in your business. Like, say, for example, personal cost, the employee cost, you may have to give them increment year on year, whether your business grows or doesn't grow, because normally that is what the employees expect, that every year they should get some increment. Now of course when the business is doing very good, you may give a higher increment, but if business doesn't do good, you may give a lower increment. But those are the fixed costs. Even your say rent could be a fixed cost, or there could be an increase, but increase may not be commensurate with the increase what you have in the business activity. And there could be other costs where it could be, some costs could be variable, some costs could be fixed, and some could be semi-variable. So while one is analyzing the projections, one will have to go into the details of each and every item of income and expenditure, compare the the assumptions made by the company vis-a-vis the past. Like, say, for example, in the past, company, like, say, in this case, as we discussed, the cost of goods sold is 75% in the, say, first column, and then which is expected to go down in future. So obviously you will ask the management that what is the basis on which they are projecting. Is it that they are going to increase the sales, or they are going to procure the raw material at a lower rate, or there is going to be some saving in the manufacturing cost. So, and as I said, it could be combination of all three of them. So one will have to understand those projections in detail, and then make a sense about how these projections are achievable. Similarly, the projections are there for the for the purpose of P&L. One will have to also project the balance sheet going forward. So as we discussed earlier, if you sell the goods but don't realize, then it will go and sit in your trade receivable. So to that extent, there is a cash which is blocked into receivables. Also, if inventory is rising, there could be some inventory which is blocked into that. Or we also looked at the property, plant, and equipment, where you may need a capex every year to sustain your business and also for the growth. This is the calculation of the WACC. There is a weighted average cost of capital. So this is under the CAPM method. There is a capital asset pricing method. As I said, if you are doing a valuation for an investor, and if that investor is expecting a particular return, that should become your discount factor. But in the absence of that, then you have to go to this other method, which is the CAPM. So here, cost of equity, I assume risk-free return of 8% in Nepal, and equity risk premium of 10%. I tried to do some research about the Nepal Stock Exchange, but I believe the number of companies listed there is not very high, and even the companies which are listed, there is not regular trading in many of the companies. So maybe then you'll have to look at what is the normal risk premium expected in the country, rather than the market data. Like say in India, we have a very robust stock market, so it gives us a lot of insight into the what should be the expected equity risk premium from the market. The logic here is that if you have money and if you don't want to take any risk, you are better off giving it to the government, and you assume the fundamental assumption is that government will not default. So you are happy, investing into government securities, and you get whatever is the return. In this example, I have assumed 8%. But if you are investing in the stock market or in any business, certainly you are expecting a much more return. So that is where this calculation comes, where to risk-free return, you also add the equity risk premium, and then there is a concept of beta. Beta is the volatility of a particular stock vis-a-vis the overall market. So if the beta of the company is 1, it is assumed that the company's return expectation will move in line with the market. Here I have assumed beta of 0.9. So that gives me a cost of equity of 17%. I have assumed a cost of debt of 10.5% and assume the tax rate of 25% in Nepal. So which gives me a cost of debt on a net of tax basis of 7.88%. So here what we are saying is that to the extent I'm able to borrow funds, that will give me the tax break. So I need to take it on a net of tax basis. The interest cost which I pay, that will be available to me as an expenditure. And then I have to see what is the how my business is funded. So in this example, we have assumed that the business is funded 10% with debt and 90% with equity. So 17% into 90% plus 7.88 into 10% will give me a WACC of 16.09. Depending on how the business is funded, one can decide whether it is 1090 or 3070, or in some infrastructure companies it could be 150-50. That equal amount of debt is taken of the equal amount of equity. Sometimes it may happen that the company which you are valuing is not listed. Then you may also have to look at are there any comparable companies which are listed in the stock market, what are their betas and what are the rate at which they are borrowing, and then of course subject to the individual adjustments of the pluses and minuses of each company, one will have to arrive at the WACC. So we have looked at the projections, we have looked at the balance sheet projections, and we have also looked at the discount factor calculation. So this is how then you will put that into your DCF calculation, where you will start with operating PBT for the projected period. Then interest and depreciation is added. So you arrive at the EBITDA. CapEx, what is required for the business, has to be reduced. Incremental working capital has to be reduced, and tax has to be reduced. So you arrive at a total outflow, and free cash flow is the EBITDA minus the three items of outflow will give you free cash flow, which the company is expected to earn year on year. And as we discussed, the business will not stop after financial year 81-82. So we also assume that it will continue for in perpetuity. So for perpetuity, then why it may happen that for next 3 years or 5 years, where your visibility, you may project say 10%, 15% growth, but you cannot assume that a company will grow at 10% or 15% forever, because after some time it will become like it will always become higher base. So it is always possible to go from 100 to 200, but difficult from say 2 million to 4 million. So in perpetuity, normally you take a growth rate which is equal to the overall growth rate of the country or the economy in which the business is operated. And like in this example, we have taken 3%. So perpetuity value is arrived. So the formula for that is 56.22. That is the cash flow for 81-82 into 103%, and that amount divided by discount factor minus growth rate. So that amount divided by 16.09 minus 3% will give us the capitalized value of perpetuity. So this is the value which we are expected to arrive in the perpetuity. So we need to arrive at the present value of today for all the cash flows which are there for the 3 years projected and also for perpetuity. So that will so you put that into the discount factor. So that, so present value factor for each year is is like 1 divided by 1 plus discount factor. For 8081, it will be the previous year divided by 1 plus discount factor, and so on and so forth. So here also one can there is another concept when you work out the discount factor, is that do we assume that the cash flows will come at the end of the year, or it will come evenly throughout the year? Like say if you are in a business and business will generate cash flows on a daily basis. So then instead of like say in this example, it is assumed that the cash flows will come at the end of the year. One can also assume that cash flows will come at the middle of the year. So you are averaging the cash flows which are expected during the year. So in that case, first year you need to divide by 2, and subsequently the formula will remain the same. So the present value of cash flows for 3 years plus present value of the terminal value will become the enterprise value, and from that you have to reduce the contingent liabilities. Like suppose if you may have any tax claim or any labor claim or any supplier's claim, and if you believe that some of that is going to hit you, you need to reduce that. Loan funds, because we want to arrive at the value for equity shareholders, we have to reduce the loan funds. If any surplus cash is there in the company, we need to add. And if company has any investments, those also we need to add. So the total of this will give us the equity value. That you divide by the number of shares, you will get a per share value. Now, when we do this valuation, we also do a sensitivity in terms of what if I use a different WACC number, or if I use different growth number for perpetuity. Now, based on that, like say in this example, I have taken the range from 1 to 5% in terms of growth rate for perpetuity, and WACC of 14.1 to 18.1. So our base rate was 16.1. We did two numbers, 2 percentages lower, and also 2% higher. So this is going to throw the range of values, and then depending on you as a valuer where you are comfortable, you can then finally decide that which is the WACC and growth rate you want to use. Now also one can do the reverse calculation in terms of whatever value is being thrown, what is the implied EV/EBITDA multiple of that. So like say for example, if any comparable company is listed, and today if you see that what is the rate at which it is traded in the stock market. So maybe this calculation will also give you the implied multiple for your fiscal year 77-78 is 7.1%, and because you are expected to grow in the future and you are dividing by the current values, the implied for a future year will always implied multiple will be lower. Coming to market price method, if if shares of the company are listed, then one can use the market price. So it evaluates the value on the basis of prices quoted on the stock exchange. So even the regulatory bodies also, sometimes like in India we have SEBI, the Securities and Exchange Board of India, which gives a lot of importance to the market price for new shares, which company wants to, additional shares which company wants to allot, or if there is any takeover by another another company of an existing company, then even the market price will give a one of the very important indicative factor. While you can use market price, but if shares of the company are not regularly traded or they are dormant and low floating stock, then one may have to ignore the market price, because then those, if there are very few transactions on the stock market, then maybe it is not giving the correct value about the about the business of the company. And if you are using say a multiple, normally like say we take 6 months average market price for any share in India, and also if the share of the company are listed on multiple stock exchange, like in India we have multiple stock exchange, there is a Bombay Stock Exchange, National Stock Exchange. So we look at the exchange where there is a higher volume, and you take the weighted average price on that exchange. So in terms of calculation, it will appear more or less like this, where you have you go back to last 6 months of the on the stock market, look at what is the monthly volume and what is the monthly turnover of in terms of the value. Total of 6 months turnover divided by total of volume for 6 months will give you a market price method. Say in this example, it is 210 per share. So this is the market price method. Under the market approach, you also have a market multiple method where you can use EV/EBITDA method or a revenue multiple, which will give you the enterprise value, or you can also use the PE multiple, where you apply a multiple on the profit after tax, which will straight away give you equity value. And you may also have asset-based method like book value multiple, straight away, which will give you the equity value, or depending on how you are taking the multiple, it may also give you enterprise value. So what are the basis on which you'll select the market multiples? So whether you'll take PE multiple or EV/EBITDA multiple or a revenue multiple or a book value multiple, and as Ms. Drushti Desai was saying, also sometimes you take a industry specific multiple. Like say for example in cement business you have a EV per ton. Now or say in hospital business you have enterprise value per bed of hospital capacity which they have. In hotel, you have quite a few hotel in Kathmandu and other areas of Nepal. So one can also take the value based on the enterprise value per number of room keys you have. Or in case of telecom, enterprise value for tower. In case of AMCs, the asset management companies, you can take a percentage of AUM. So various industry specific multiple may be used. Only thing you have to be very careful when you do that, because sometimes this your company and the transaction which you are using may not be comparable. Like say for example, if in terms of hospital now, again depending on where the location of the hospital is, what kind of treatment they are giving, whether they are giving all the treatment or they are giving very basic treatments. So then maybe both the hospitals are not comparable. Or even in hotels, you may have 5-star hotel or you may have 4-star and 3-star. So for a valuation of 5-star, you have to take 5-star comparable, and you can't take a 4-star and 3-star, because then it may not be comparable. So those are the things which you have to keep in mind while you take any industry specific multiples. Now when you apply the multiple you apply on what? So multiple you have to apply on the profits. So maintainable profit you need to arrive. It is based on the past performance and or estimates. So either you can take past, or you can take future, or you can take combination of that. If there is any material non-recurring or non-operational items of income or expenditure are there in the past, you have to ignore, because you always assume that those non-recurring items will not arise in future. Like say for example, if you are valuing any company manufacturing plant where there is a fire has taken place say last year. Now if fire has taken place, then obviously because of the fire maybe the plant was shut down for say few days or few months, and also because the plant was shut down, you could not earn the profits. And also on top of that, there is a cost which you have to incur to make the plant proper. Like say whatever damage has happened because of fire, you may have to make it proper. So then you may have to adjust the past profitability for this event, like there is a fire or say any other like say COVID. Now COVID again, we can't take the COVID years as a comparable, because the entire world was shut down. So maybe that year itself is not representative of future. Now sometimes you also have recently added capacity, or you are just about to add the capacity. Now in that case, your past is not comparable with the future, because in the past, like say for example in cement, in the past you had say 1 million ton, and now you are making 2 million ton. So obviously profitability of 1 million is not comparable with the profitability of 2 million ton capacity. So you may have to make adjustment for increasing the capacity. And instead of taking one particular year, one may want to take a average of various year. Now again, you can take a simple average or a weighted average for the years to arrive at the maintainable profits. Now, when you take the market multiples, what are the factors which you will keep in mind? Past and expected growth rate of earnings, performance of the company vis-a-vis its peers, size, location, and market share. Like say, for example, I told you that a hotel in Kathmandu may not be comparable with a hotel in Pokhara, or within Kathmandu, you may not have a 5-star hotel may not be comparable with 4-star. So those kind of things, you'll have to keep in mind. And also, if there are listed companies, then what kind of multiples they are enjoying on the stock market in the past. So that also you'll have to keep in mind. So this is just a very basic calculation of the EBITDA calculation, where you past 3 years you reported EBITDA of 100, 140, and 180, and in those years there are adjustments of say in the first year there is a loss of due to fire of Nepalese million 20 million Nepalese rupees. So because there was a loss and you assume that loss will not have in future, you made the adjustment and make the adjusted EBITDA of 120. Then in year 2 you may have a gain on sale of investments of 30 million. Now, so when we talk about the investments, income will not come every year. Like if you sell the investment, then it's a one-time income. It is not your operational business income. So that has to be adjusted from the profitability. And in this example, in the third year, there is an increase in the capacity, and because of but that it was not fully operated for the year 3. It was only operated for the say 50% of the period. So then you may have to also take the for the period for which capacity was not operational, but in future it will be operational. So you add that much amount and arrive at the adjusted EBITDA. So in this example, if you see year 1 there is a 120, year 2 it is 110, and year 3 it is 240 million Nepalese rupees. So obviously, if you are doing a valuation, you can't compare year 1, year 2, and year 3 because they are not comparable. For the simple reason is that in the year 3 there is increase in the capacity, and going forward now I will have a higher capacity. So maybe 240 will become my base for the to apply the multiple. Now having arrived at the value, arrived at the EBITDA, you need to find out what is the multiple which company can enjoy. So maybe you will look at the comparable companies which are listed on the stock market. So here, see in this example, there are 4 companies, A, B, and C, and D. Each company will have its market share, market capitalization. So market capitalization is the number of shares which are listed, and the multiplied by the price at which they are traded. So that will give you current market cap of the company. From that, on that you need to add the loan which is there in the books of the company, or revenue is also you can put it. So this example will give you adjusted EBITDA of, let's say, of all these companies has 69, 40, 80, and 12. And based on this, EV EBITDA multiple is say for A Limited it is 9.06, for B Limited it is 9, for C Limited it is 8.75, and for D it is 4.08. Now if you notice here, the market cap of the first 3 companies is very high, whereas 4th company is very low, and its multiple also is very low. So maybe then you can assume that 4th company is not representative of the entire it's like outlier, and you can take only the average of the first 3. If you take average of first 3, the average multiple which comes is 8.9. Now whether you want to use the 8.9 straight away or here also, then you may have to make adjustment for discount for illiquidity or discount for size, because the company which you are valuing may not be comparable with A, B, and C directly. There could be some pluses and minus. So based on your analysis of your company vis-a-vis this A, B, and C, you will decide whether you want to apply a discount or you want to apply a premium. There is a concept of discount for illiquidity, as Drushti Desai mentioned. Also, there is a control premium and a lot of those other factors which come into picture. So here for the company in the past, we have taken what is the adjusted EBITDA calculation is this. So you start with reported profit before tax. From this you remove the interest income, which is a non-operational income. Arrive at adjusted PBT, add interest and depreciation for the 3 years, and arrive at the adjusted EBITDA. When you plot this in your to work out the values, you will find that the first year is only 27.66, then 40, then 54, and 66. So maybe the first 2 years are not comparable. So either you can use the 4th year or you can use the average of year 3 and year 4. In this example, I have taken average of year 3 and year 4, which gives me maintainable EBITDA of 60.79. Now to this, I need to apply the multiple. So the average multiple of comparable companies we arrived is 8.9. But I'm assuming that my company is not as large as those companies, and also my company shares are not listed. So there is a discount for illiquidity. So I assumed a discount of 30%. So 8.9 into 70%, it will give you 6.23. So based on that, I get an enterprise value of 378 million Nepali rupees. Add cash, add investments, reduce contingent liabilities and loan funds. That will throw me the equity value. Divide by number of shares, I get a per share value under EV/EBITDA method. Now you have comparable companies multiple method. You may also have comparable transaction multiple method. So like we discussed for the past, you may have a EV per cement, per ton of capacity in cement, or for a hotel it could be EV per number of keys, or a hospital it is EV on number of beds and all those things. So you need to determine the value. This method determines the value based on the recent transactions in the comparable companies. You need to take the multiples derived from the recent M&A transactions, like EV to EBITDA or EV to sales or a book value or industry specific multiple. Normally, we use this more as a cross check rather than the main method. So like say you do a DCF, and also there are comparable transactions. You may want to check that what is the multiple at which those transactions happen, and try to compare your DCF value vis-a-vis the transaction multiples. If there is a material difference, then you may have to go into the details. What is the reason that you why your final result is not comparable with those recent M&A transactions, and there could be many reasons. So one will have to, and sometimes the main issue in the M&A transaction is that you are outsider. You may not have the full details about the transactions. What are the contours of the transaction? Like say sometimes parties would have agreed that okay, we do a value transaction at a particular EV to EBITDA multiple, but in case the company does not achieve what is projected, then there will be adjustment in the value. Now those things will not be in public domain. So that is where you have to be a little careful when you are taking the M&A transactions. So here the comparable transaction method, we are valuing a PQR Limited, which is engaged in the business of generation of renewable energy. Presently, PQR operates power plant, hydro power plant, and wind power plant, and they also have a cash and bank balance and borrowing of cash and bank balance of 17.13 and borrowing of 44.05. And from the past transactions, we can see that there are certain transactions which have taken place in the renewable energy. Some are in solar, some are in wind, and some are in thermal. So then one will have to go into the what is the enterprise value at which those transactions are done, what is the capacity of those plants in terms of whether solar, wind, or energy in terms of megawatt, and what is the implied EV to megawatt which is coming out. Like say first item is a June 73. Now maybe this is very old transaction, so we may not want to use it. Second transaction is in wind, which is recent transaction of January 78, not very far off. So maybe you want to use that. Third is of a thermal. Now thermal and renewable may not be comparable, so you may want to ignore that. Fourth is of solar, so you may want to take, and fifth is a transaction which that the transaction has taken place, but you don't know what rate it has taken place. So details are not available in public domain, so you can't consider that. And last one is again in solar, so where details are available. So out of the 6 transactions what you may have in this example, you are able to use only the 3, the second, fourth, and sixth. So here then you apply those multiples into your transaction. So your plant has a capacity of 73 million, and you are applying a transaction multiple that is EV per megawatt of 5.4. So you have taken average of the first, the second, fourth, and sixth, and obviously you are giving maybe some discount for some obvious reasons. So the multiple which you are applying is 5.4. That will give you the enterprise value. On that you add cash, add value of investment, remove the contingent liabilities and loan funds. That will give you equity value of NPR 387 million, and divide by number of shares, you will get per share value. Cost approach is asset minus liabilities or share capital plus other equity, which will give you the net asset value. Now, when you do that, you may have a replacement cost or realizable value method, as Mr. Drushti Desai just mentioned before some time. So when you are taking a replacement value of asset, you have to be careful about the cost of new asset. Now it may happen that because of technological improvements in the current technology, the asset what you have may not be the new asset is not available. Let us take a simple example of a computers. Computers, today say somebody has a i3 old one, and currently say you don't, maybe you are not getting i3, you are getting only i5. So then only i5, so i3 and i5 are not comparable because there is a technological advancement. So then you may have to take the you have to find out, if I want to use this, if I want to replace the current asset, how much it will cost you. So you may have a difficulty because of this, because of technological improvement in the underlying asset. Now another thing is, in terms of utility also, it could be different. Like the example we take of a computer, i3, obviously i5 is much faster than i3, and i7 is even faster than that. Also there could be difference in the storage capacity. Somebody may have a 540 a GB hard drive, whereas somebody may have a 1 TB. The new ones may be coming only with 1 TB. So all those things we'll have to keep in mind while taking the replacement value of asset. Realizable value of asset, here you are assuming that you will sell the assets in whatever condition, and you will realize the value, and that becomes your value. So here you have to factor in the cost of disposal. If any tax is to be payable on the sale, then that has to be considered, and the time which will be required for you to dispose of the assets. And if say time required is say more than 1 year or 2 years, then you may have to take the present value. Also, if you take a present value, you can also make an assumption that today the realizable value is 100, but next year because of inflation it may become 103. So depending on the facts of the case, you have to decide what is the realizable value, when you will realize those value, how much cost you have to incur for disposal, if any tax has to be paid, has to be reduced, and if time is more, then one will have to take the present value. This is the example of a net asset method. So you start with property, plant, and equipment, add investment, make adjust, and take net current assets. So current assets minus current liabilities, reduce the loan funds. So you get a net asset value as per the accounts. Now investments, maybe which is there in your books, if it is at historical cost and current realizable value is higher, already to the extent it is there in your books, it is taken above 10 as a part of investments. The appreciation in value of investment on net of tax basis has to be added separately, and contingent liability has to be reduced. So you arrive at the adjusted net asset value divided by number of shares, you get a value per share. Now, whenever you do any valuation, there are some adjustments which could be required. So, like say market value of investments, already we have we have discussed earlier, where if I'm valuing an investment holding company, I may have to take the underlying operating company's value at the, either if they are listed at the market price, or if they are operating companies, I may have to take DCF or a EV/EBITDA and CCM method. There could be other non-operating surplus asset, like say company has a, say for example, company has a manufacturing facility, and it is say 200 biga is the total land which they have, or 200 say acres or square meters, whatever you want to take. Now the the area on which plant is located, say, is only 60%. So out of 200, only 120 square meters is is utilized. Balance is surplus, and if you are able to sell that asset, then you have to take the operational value of the business, separately add the value of the surplus asset on a net of tax basis. Surplus cash also has to be added. Contingent liabilities are like say tax demands, or demand from suppliers, or demand from say your employees. One will have to go into those details, find out that what is the likelihood of how much of that is going to hit you, and to that extent you may have to reduce the contingent liability from the overall value. Loan funds have to be reduced to when you arrive at the value for equity shareholders. Now also sometimes company may have some potential dilutive instruments like ESOPs or warrants. Now those ESOPs and warrants are potential dilutive instruments. So like say for example, if you have given today's shares are listed at say 100 rupees, and but already company has given ESOPs in the past to employees where employee can pay say 40 rupees and convert into equity share. Now, if market price is 100, obviously we can assume that the employee is going to convert. So when you do the valuation, you take the amount which is going to come from the exercise of ESOP, and when you divide by number of shares, you take higher number of shares on a dilutive basis. But suppose if current market price is 100 and ESOPs are convertible at say 150, then obviously the ESOP holder is not going to exercise the option. So he's going to just leave it as it is. So then you may have to ignore that ESOP. Similarly, also if you have convertible warrants or any other instruments, one will have to see whether they are in the money or out of the money. If they are in the money, you have to take impact in the valuation. If they are out of the money, you have to ignore. Sometimes in some of the, of course, I don't know much about the Nepal tax system, but say you may have some tax concessions. Now some of this tax concession could be permanent, some of this tax concession could be temporary. So to the extent it is permanent, I need to adjust in my tax rate. If it is only temporary, then I may have to to the extent it is available, say it is available only for next 2 years. So next 2 years I may take lower rate, and then I may take a higher, which is the marginal tax rate applicable for companies. So when you use the multiple methods, it will throw a range of values. You have to consider the relevance of each methodology depending upon the purpose and premise of valuation. You may do a mathematical average. Ultimately, it is a professional judgment and subjective value. So like say you do a DCF, you get a particular value. You do a EV/EBITDA, you get another value. Now, depending on the outcome and your understanding of the business, you have to decide whether I want to take a DCF or I want to take EV/EBITDA or I want to take average of both. So that will depend upon the facts of the case. Now, this was the case study for the individual methods for a particular valuation of a company. Now, also sometimes you have to value the companies for the purpose of amalgamation, where say two companies want to merge. So here I have taken example of two companies. So Bottlers Nepal Terai Limited with Bottler Nepal Limited. I believe that both are Coca-Cola group companies and they are listed on the stock market. So I have taken the information which is available in the public domain. So here there is amalgamation of Bottlers Nepal Terai into Bottlers Nepal Limited. Both are listed on Nepal Stock Exchange. And in case of Bottlers Nepal Terai, 90% of shares are held by Bottlers Nepal Limited, and 10% are held by the outside shareholders. So now here, when you do a valuation for amalgamation, it's a relative valuation because here consideration will not be discharged in terms of the cash, which will be paid. It is the if say Bottlers Nepal Terai is amalgamating with Bottlers Nepal Limited, Bottlers Nepal will issue its own shares to the outside shareholders of Bottlers Nepal BNT, Bottlers Nepal Terai. So here, what I have to do is a relative valuation. I have to compare both the companies on an apple-to-apple basis, and based on that, I need to arrive at the relative fair values, and based on that, I will arrive at the swap ratio. So here, the outcome of the valuation will not be that value of the company is X rupees per share or Y rupees per share. It will be for how many shares of BNT, how many shares of BNL needs to be issued. So the example which I have taken, I relied on the information which is available in the public domain. So this is the BNT valuation, where the net asset method, I've taken asset minus liability divided by the number of shares. I get a per share value of 2651 Nepali rupees. This company is also listed. So 6 months, I've taken the turnover from the Nepal Stock Exchange website, which gives us the value of total turnover for 6 months. Also total volume of shares traded. If I divide the total volume by total turnover, it gives me average price of 14,325. Now I also do need to do valuation on the other method. So here I have taken EV/EBITDA method, where I've taken the past of the company, and TTM is, if the shares of the company are listed and they are giving the information on quarterly basis, then there is a concept of TTM. So trailing 12 months, what is the profitability? The profitability of the company is plotted here. Non-operating and non-recurring item of interest income is reduced, and from that, on that you add interest and depreciation, you arrive at the adjusted EBITDA. Now adjusted EBITDA, you put it here. Now here again, if you see the EBITDA, is increasing year by year, and maybe the previous 2 years could be impacted because of COVID. So we are better off taking the TTM, that is trailing 12 months profitability. On that, the EV/EBITDA multiple of 9 is applied. You add the cash, reduce the loan funds, you will get per share value of 13,659 for BNT. Similarly, for BNL, you get a per share value of under asset method of 2364. Now here, if you see the last 6 months, there is hardly any trade. So only 381 shares are traded. So maybe one can reach a conclusion that this market price is not representative of the true worth of the company, because there is hardly any. I believe only in last 6 months, only 2 days, some trading has taken place of very less volume. So maybe one can conclude that this is not the correct value of the company. So here again, TTM, EBITDA calculation has been done. So adjusted EBITDA, what you arrive for the past 3 years is 922, 1527, and 1875 million. When it comes to the arriving at the maintainable EBITDA, again, weight is given only to the TTM profitability, because we can assume that previous 2 years are impacted because of COVID, and I'm only taking the TTM method. And I'm again here I'm applying a multiple of 9, which is the same multiple I had applied for BNT. So that is where I need to compare both the companies' pluses and minuses, and I need to arrive at a relative multiple for both the companies. So suppose, like in this example, the assumption is that both BNT and BNL, in terms of profitability and the business, are comparable. So you are using the same multiple. But if you believe that one of the company is superior, then you may give a higher multiple. Or if one of the company is inferior relatively, not vis-a-vis anybody else, but vis-a-vis the other company, then you may apply some discount to the multiple. So here, of course, I have assumed the same EV/EBITDA multiple for both the companies, and then I plot values of both the companies under various approach in this table. Now here, if you, as you all see, as far as BNT is concerned, we also have a CCM method and we have a market price method. But in case of BNL, we are saying NA not applicable because the shares of the company are only very infrequently traded. So we are ignoring that, and we are comparing both the companies only under the CCM method. So based on that, the value of BNT works out to 13,659 per share, and value of BNL works out to 7,963 per share. So if I have to give my recommendation, I will not talk about 13,659 and 7,963. I will talk about that for every 1 share of BNT, BNL will have to issue 1.7 shares. So, or say for example, for every 10 shares, they have to issue 17 shares. And again, one may have to round off if shares of the company are listed, because suppose if based on this calculation you are getting a ratio of 1.687945, something like that. Obviously, you can't give a swap ratio of such a higher digits. So then you round it off to 1.70, and you will say for every 1 share of BNT, I'll give you 1.7 share of BNL. Now there are certain practical issues which you face in the valuation. So selection of methods, like say different businesses of transferor and transferee company. Sometimes you may have to value a conglomerates where a company's business is multiple businesses. So like say company may have a power plant in its company, also may have a FMCG business, or they may have any other business. So all those, if there is a conglomerate, maybe you may have to do a sum of parts valuation. So value power plant as power plant, value cement plant as cement plant, and value the FMCG business as FMCG business. Add up all the values and reduce the loan funds. And while doing that, also you have to keep in mind the corporate cost, which could be there, which is sitting at the higher level. That has to be factored in or apportioned to all the businesses. Otherwise, you'll make a mistake. You'll take all the, you may ignore then, unknowingly you may ignore the cost which is sitting there. So that cost has to be apportioned. Arrive at the each values arrive at the values of each business, and sum it up to arrive at the value of the conglomerate. So sometimes there could be some synergies of restructuring. Like say for example, we have previous example we have seen that we are doing a valuation for merger of BNT and BNL. Now obviously, if both the companies amalgamate with each other, there will be certain synergies in terms of there will be some reduction in the cost which they may have, or there could be some other synergy benefits like once both the companies are combined, then they may have a higher bargaining power with the supplier of the material. So all those synergies of restructuring, normally it is not captured in the valuation. especially for the merger. It is valuation is done on as is per is basis, and then whatever synergies are there, as and when it is realized, it will be enjoyed by both the company shareholder going forward. Valuation of investments, already we have discussed that if company has investments, I need to take those investments at fair value. So I may have to do a valuation of those underlying investments. And surplus asset, sometimes, like say I gave you example of a land. Now, if land has to be, surplus in terms of separable and sellable. Suppose if land is not separable and sellable, then it is not a surplus. Even though you are not using that land, but if it is not separable and sellable, it is of no use. So identification of surplus asset is an issue. If sometimes, if you are taking the valuation of fixed assets or surplus asset, normally we are financial valuers, so we don't know what is the value of land as a land. So then maybe we have to rely on the third-party experts who are expert in the field of valuation of land and take their report in our calculation. And contingent liabilities, I discussed that if it is there, we need to reduce. Sometimes company may also have some contingent assets which are not recorded in the accounts. Like say company has some claim on the some customers which are not accounted for the sake of prudentness. So those contingent asset also one will have to then add in the value. ESOPs and convertible instruments already have discussed. If they are in the money, you have to take. If they are out of the money, you have to ignore. If you are taking the market price, then depending on what is the your valuation date, you will take cutoff date as the market price, and depending on how backwards you want to go, whether you want to go for 1 month, 3 months, 6 months, you may go backwards for from the cutoff date. Sometimes both the companies, especially in case of a merger, have a different accounting policies. So then the financial results of both the companies are not comparable. So then you may have to use the change the accounting policies of one of the companies and see what is the impact, and then both the companies are comparable. So based on that, you can arrive at the value. Sometimes companies do this corporate action like bonus or stock split or some special dividend. Then that also you have to take into account when you are doing the valuation. Sometimes you may have intercompany holdings in merging companies. Like say in our example, BNL is holding 90% of BNT. So what I will do, as far as BNT is concerned, I will value it. As far as BNL is concerned, I will take the valuation of business of BNL, plus I will also add the 90% value of BNT while arriving at the value of BNL. Also, the report, normally what we do is the report what we prepare, we share it, with the clients to ensure that there are no like before we finalize the report, we share it with the client at a draft stage to ensure that we have not missed anything, because we are a financial valuer. We come into picture very few days back, whereas company is in the business and the management is in the control of the company, so they will have a lot of information. It's always better idea to share your draft report with them, and if you missed something or if your understanding is different than the management, they can draw your attention, and then ultimately it is the call which you need to take. But it's better to always share the draft report with the client. Sometimes clients will always put a lot of pressure on in terms of timelines, that I need to do a deal in next week, so you give me valuation in 7 days. So one has to be careful. Ideally you should do a valuation only when you are comfortable with the timelines. If you are not comfortable, you tell the client that it's 7 days, it is not possible, I will take 10 days. So then let client come back and say whether 10 days is okay with them or not. Or sometimes there is a change in scope of work. Initially you assume that you are doing a valuation of business. Now there is a valuation of share. So maybe you may have to have some different approach in the valuation, or you may have to take some extra information, or some information which is taken may not be relevant in the change of scope of work. So again, there could be some issues which is coming out of that. Also, I will show you some case studies on the valuation of intangible assets. Now, till now, what we have discussed is the valuation of shares of the companies for a normal transaction and also for the merger. Now, also, you may have some intangible assets. So, what are the intangible assets? Intangible assets are identifiable, separable, or arises from contractual or legal rights. Like say, you may have brand or trademark or a copyright or a technical know-how or any other business or commercial right. So, intangible asset is a non-monetary asset without physical substance, but if you have that asset, certainly you are able to generate the profitability from that. It grants economic rights and or benefits to its owner, represents legal rights developed or acquired by an owner. It should be transferable intangible asset, and goodwill is not an intangible asset. So goodwill is the residual amount, after ascribing values to all identified intangible assets, other assets, and liabilities. What are the examples of intangible assets? You have marketing related, like trademarks, trade names, brand, trade dress, like color or design, internet domain names, like say your ican.org.np is an intangible asset as far as the Institute of Chartered Accountants of Nepal is concerned. Obviously, nobody else can take that, so that becomes an intangible asset. Or any manufacturing company is there, their internet domain name again becomes a intangible asset. Or non-competition agreement also is an intangible asset. Then you may have technology-based assets like patented technology, unpatented technology, computer software or database. You may have contract-based like licensing, advertising or supply contracts, lease and franchise agreements, construction permits. You may have customer-related like customer list, order or production backlog, customer contracts, non-contractual customer relationship, or artistic could be plays or operas, books, magazines, newspapers, music compositions, songs, lyrics, advertising, jingles, pictures, photographs. All these are examples of intangible asset. Now, we normally as a financial valuer are able to value the assets where which are income generating. Like say for example, if you are talking about plays or operas, if they are regularly being played at various locations, we can look at what is the income which they are generating, and we can do valuation based on that. Or say music composition, song, lyrics. Again, if they are income generating, one can do it. But if like say photograph, like say Mona Lisa photograph, which is there in one of the European museum, certainly it will have huge value. But we as a financial valuer, we will not be able to put that value, because one is it is not available for sale, and we will not know what is the value of those that intangible asset. What are the valuation approaches which you will use for intangible asset? There is a price market approach, price and valuation multiple and capitalization rates, income approach, relief from royalty method, multi-period excess earning method, with and without method, under cost approach, replacement cost and reproduction cost. So under income approach, you have RFR, there is a risk-free relief from royalty method. Here value is determined based on the present value of royalty payments saved by owning the asset instead of taking it on lease or over its remaining useful life. Like say for example, we took example of say Coca-Cola. Now Coca-Cola Nepal could be owner of that Coca-Cola name, or maybe it is licensed by Coca-Cola Global US to say Coca-Cola Nepal. Suppose if it is owned by Coca-Cola Nepal, then, or say if it is not owned, it is licensed by Coca-Cola US, then Coca-Cola Nepal will have to pay a regular some royalty payment, maybe say 5% of the net sales. They may have to pay as a royalty for use of Coca-Cola name. But suppose if Coca-Cola Nepal is already owning that asset, then they are saving that 5%. So the present value of the saving relief from royalty what you have can become the value. Or next method is a meme method, which is generally used for valuing intangible asset, that is leading or the most significant intangible asset out of the group of intangible asset being valued. So sometimes you may have that in business, you may have multiple intangible asset like patent, trademark, copyright, brand, customer network. All those things could be there. One will have to find out which is the leading asset, and that may be valued based on the profitability method. Other assets, depending on the nature of that, one will have to decide which method we want to use. Third method is a with and without method. Mainly it is used for like say for example valuing the non-compete agreements, that what kind of profitability I will earn if I don't compete, if my the person from whom I purchase the business competes, and what kind of profitability will I earn if he doesn't compete. The difference between those two value can become the value of the non-compete agreement. So I've just put some case studies of intangible asset. So here we are valuing is the current case study is on intangible asset, including valuation of following assets of ABC Limited, which is into providing IT software services. So where you may have technical know-how and brand. Kindly note, due to technological advancement and possibility of overall of technical know-how in the future, the utility of technical know-how is assumed to be for 10 years. So here, because it is an IT software services, we are assuming that this intangible asset is not for forever. It has a utility only for next 10 years. After that, there will be some new software will come in, and I may have to replace or discard this software. So the assumption is that I have this benefit only for next 10 years, and here discount rate of 17% has been considered. So under MIM method, I start with the revenue of the company for next 10 years. I arrive at the EBIT, that is earning before interest and tax. I need to reduce the tax amount from that. Now, to earn this profit, there are some other assets which are giving the which are used. So that is where there is a concept of CAC, that is a contributory asset charge. So if I want to value the software per se will not give me the value. It is the business which is giving me the value. So when I want to bifurcate the value for software, I need to also reduce from the profitability the contribution required by the other assets, in generating that income. So the CAC for fixed asset and working capital is reduced. CAC on brand is reduced, and CAC on assembled workforce, because assembled workforce also is a asset. So if company has a employees which are trained and say they are there with the company for say a couple of years, then they also have a value. So that is a value of assembled workforce. So CAC for all the three I need to reduce, arrive at a net cash flow, need to apply the discount factor, and arrive at the present value. So in this example, the present value of technical know-how is 217.66 million Nepali rupees. Under relief from royalty method, I take only the revenue and say if I'm by owning this asset, if I'm saving the 5% royalty, which otherwise I would have to pay. So 5% of the revenue is taken. From that, tax rate is reduced. I arrive at the net of tax royalty method. Sorry, net of tax royalty amount. Apply the discount factor and arrive at the present value of royalty, and which will give me the value of brand at say 75.01 million Nepalese rupees in this example. So this is end of my presentation. I will be happy to answer any questions which any of the participants may have. And I hope I've tried my best to give you the insights into the valuation principles and the case studies, the subject which was assigned to me. So if any questions are there, I'm happy to answer. Somebody has asked how to get slides. So what I can do is I can mail this my presentation to the the Institute of ICAN or maybe ICA RBO in India, and then they will forward it to the your institute.
Thank you, Parag sir, for your great presentation.
Yes, sir. It's my privilege, privilege to be with all of you.
I guess there is no questions till now. There is nobody has asked any question. Still we have 5-6 minutes left as per our scheduled time. So if there is any questions, we could take one or two brief questions. If there is no question, then we'll end the session.
So if there are no questions, I will assume that all of you have become master in valuation.
Could be. Okay, sir. Thank you so much. We'll end today's session. All my seniors and my friends, see you tomorrow. Tomorrow we'll have valuation of intangible assets and valuation of financial instruments, as well as valuation reporting formats. So see you all tomorrow. Thank you, Parag sir, once again. And regarding the presentation slides, what we do is we'll get all the material from Valuation Standard Board of ICI, and we'll compile it and we'll post it in our website, and we'll share the link to all the participants via email.
Okay, sir, no problem.
Okay, thank you. Good night, sir.
Thank you, sir.
Good night,
Good night.
all my
Good night.
seniors and colleagues.
Thank you.
Okay, bye.